Since most of you guys, I think you have registered or at least saw the link for this workshop meetup at the meetup.com page. Basically, I'm co-organizing it with the group Machine Learning Milan, and basically this guys started organizing meetups, workshops, some sort of small conferences about machine learning for several years, and I was joining, I think, last year or so, and helping with the some promotion of these events. So later they're organizing every couple of weeks the events. So they're on reinforcement learning. They're guys from N26 Bank, etc. So I think you can follow the group and check more events. Usually they're pretty good. And also I've been asked to share that there has been new conference, ML Conference EU. So if you guys also want to share something, I'm gonna send a link to our chat, here. Basically, if you guys are interested to give a talk, if you have something to share, a workshop, they are inviting you. This is about the group, and a couple of words about me. Basically, what I'm doing, it's 3 sort of activities, but all of them are around machine learning. I'm co-founder of Neurons Lab. It's a consulting software development company, and we develop AI products. I'm a practitioner myself, so basically, apart from managing things, I didn't forget how to code. So I'm still practicing mainly in the field of finance and the healthcare. Short time ago, I wasn't even the top 10% in the data science contest Numerai, which is about financial predictions. But we'll talk about it. I was kind of lucky to be there because I was submitting kind of smart linear model. And as we will see today, linear models are not good in finance. But I kind of used some tricks that made me, even with the very simple, it was like logistic regression, go quickly to the top. But of course, I knew that it will not be last for long, and it didn't, but still it was a nice experiment, and I'll talk a bit about it. And also I'm spending some time doing some content, mostly educational. I'm writing and teaching some workshops. I also taught in a couple of universities. It's University of Verona, Ukrainian Catholic University, Kyiv Polytechnical Institute. So basically, this is my main activities. And I think the question I usually ask when I'm giving some workshops or something, what are you guys doing and why you're here? So basically, as I'm always saying, I'm trying to be flexible and I'm trying to adapt the material I prepare for you. So if you can share a bit more what are you doing and why you're here, so what you want to see, what you want to learn, you want theory, code, education plan, you have some specific problems. Let's just make this event as most useful as we can. So basically, this is for your results, first of all. And that's why my question is what you want to get. Because I have some slides, I have some pieces of code, but again, what I'm gonna talk and what we're gonna do will be depending on you. So I'll wait till some comments. At least you're 15 here, maybe at least 5 comments would be nice. Learning new approaches of ML finance, but okay. But are you already working in financial field, or you're data scientist working in other fields? Basically, it's okay, when I'm asking who are you and what you want to do, it's I'm asking kind of point A and point B. It's I am data scientist working in a hedge fund. I want to improve my performance, or I'm data scientist working in computer vision. I want to switch to finance, or I'm Python developer and I want to work in a hedge fund. Things like this. AI in asset management. Actually, today I'm not really gonna talk a lot about asset management. At least I didn't plan to. But I think we should emphasize about it a bit more because it's still relevant. Security selection, risk management. Okay, I understand. I think I'll add a bit more on this. I do machine learning on structured data, deep learning, healthcare, but in finance too. I like cross-exchange of ideas. Actually, I'm also interested, basically, my background is like healthcare, especially bioscience, electrocardiograms, and finance. And actually where I see like the really good intersection, the risk management techniques for finance. And when you apply them in the healthcare, basically you evaluate the risks of your models, for example, I know for like even diagnosis much better, because I think you know why. Because people in finance, they're really crazy about risk management, and I think people in healthcare also can benefit from that as well. Security selection, risk management, I work for a bank. I think for you it will be very useful. Software development with some experience in ML. Okay, I think there will be enough code today so you can apply things straight away. Also, I'll upload everything to the GitHub so you guys can reuse the code. All right, and also let's say okay, then let's go next. Basically, what I'm not going to talk about today, it's about technical analysis. I mean, we will extract some technical analysis features, but this will be something like just a reference features. We are not going to talk about deep fundamental analysis, basically analyzing why some company performs good or not good. And we will touch a bit complex mathematics, but I really recommend you to follow up after this workshop exactly with like starting with some mathematics, and you'll see why. And deep learning is not the topic for today, so that's not what we're going to do today with this guy and the background from the Wolf of Wall Street. What at least I was planning to do today is to make a recap about why like best practices from industry, from academia in machine learning, they fail in working when you work with real financial data, which is very noisy, which is simply different from images, structured data, sounds, etc., etc., etc. Today, I think we'll have like three main focuses from the technical point of view. First one will be metrics, and I'll tell you how you can treat even like classical like F1 score, Matthews correlation coefficient, accuracy from a bit different point of view. For example, if you validate in some trading strategies, even though you use like something like Sharpe ratio or another risk-adjusted reward, also you'll see how you can kind of tweak a bit the understanding of this metric and how you can basically use these metrics in different ways. Then we'll work on the data simulations, and because when you have the simulations of data, different scenarios, you can obtain the distribution of events, and we can have the probabilistic versions of all these metrics. And also a couple of notes on overfitting, which I think are reapplicable to any other field. So this is the plan for today, what I planned, and of course I will take into account that we have the things to do. All right, and I wanted to start with a recap of the econometrics, because we are working in finance, and finance started with econometrics. So the first thing we want to see how people were dealing in finance before. One moment, buongiorno. Sì. Sì, credo di sì.
Da quando?
Da stamattina.
Ah, avete aperto stamattina?
Sì, ho aperto stamattina.
Sì. Perché io volevo parlare con una signora bionda.
Ma lui non è qui. Credo che lui non sta lavorando in weekend.
Come?
Lucia, sì?
Sì, penso che è Lucia.
Normalmente lei non è qui sul weekend.
Lunedì, martedì.
Sì, lunedì sì.
Avete un numero di telefono?
No, no, no. Io sono residente qui, no, io non sto lavorando qui.
Ah,
Sì.
capito. E la signora lì c'è dal lunedì in poi.
Sì, sì, normalmente sì.
Bene, verrà a fare un giro allora. Però sai, se telefonavo prima, magari forse ce l'ho nell'email.
Sì, credo di sì.
Grazie.
Niente. Sorry guys, I supposed to be alone on the weekend in the coworking, but there are people coming. Basically, what I wanted to tell that since finance started from econometrics, and this is the great presentation from Marcos Lopez de Prado, and basically a lot of things that I'm going to show today are inspired from his findings and his research work. And I wanted to start a discussion from seeing why classical approaches, as a classical mathematical modeling, fails. And basically, what is econometrics? Is the field when we are taking some financial variables. For example, it can be, normally it's like asset prices, some financial instruments, which can be stock prices, bonds, options, or some other instruments, and you want to value them. And you want to value them based on some features, and these features can be, I want to explain the movement of Apple stock based on the whole technical market in the United States, or you want to predict Apple price based on some fundamental features of the Apple, for example, how much they earn, what is their debt, what is the market share, etc., etc., etc. And usually there are some linear regressions, and even the really big econometrical findings, they're literally linear regressions. But the thing is that that data in finance is, in reality, it's not linear. Basically, we are not working with some one-time series of the financial reports, one-time series of the market data, time series of the Apple price, and we just build linear regressions between these features. And the relationships are also not linear. So basically, when we talk about, for example, technology market, it's kind of hierarchical. We can split it between, for example, this is the web companies, this is hardware companies, this is banks, this is some startups. And they have, first of all, some hierarchical relationships, and even between these hierarchies, they're not linear. Of course, for example, Apple and Microsoft, they're kind of competitors at some point, so their price movements might be correlated, and correlation is the linear measure of similarity, but they're not necessarily linear always, because Apple produces one product and Microsoft produces another product, and Amazon produces third product, but they all are part of technology market. So taking into account these complications, econometric methods that are simply linear regressions, they're not really good in working with this kind of data. What actually really happened in finance, for example, if you look at the stock exchanges, the data is not just pure time series, it's the separate trades, and this data is completely unstructured, and it's a challenge to represent every single trade on the exchange as a nice looking time series. Also, these correlations are actually very noisy. So that's when we are saying, when we want to look at correlations, it's an assumption, against econometrical assumption, that people 50 years ago were thinking, okay, if the prices move together, they're correlated. But if you look deeply in the correlations, it's not always true. And they're prone to some outliers. So when we feed these linear models, you can see that we can simply fit to some outliers, which can be, for example, some startups or something like this, and our linear models will behave bad out of sample. And also correlation, it doesn't take into account some clear not linear relationships. For example, okay, if relationship is linear, correlation works here. But for example, if relationship is like this with some modulo in the formula, even with our eyes, we can see the pattern, we can define this relationship, but the correlation will be around 0. But for example, some another nonlinear metric will show high high dependency. Also, the problem of econometrics that these models they're designed to explain variance in samples. So basically, when, for example, you build some linear regression, for example, I predict Apple price based on the two fundamental properties of the Apple and the technology market of United States. It means that you are not build something like cross-validation. You don't split your data into train and test. You just take time series on 20 years, fit linear regression, and you say something like variance, like explain variance. So basically, this is wrong goal, because maybe this way you can explain some properties. You can explain the less depth Apple has, the higher is the price. Okay, but it's the explanation of something in the past, and it doesn't mean anything for the future patterns. It doesn't take this into account. So basically, it has nothing to do with causality, and it doesn't predict anything. Also, when we define these financial variables like debt, EBITDA, market share, etc., 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 again, it doesn't mean that they are connected linearly, and that's where machine learning can be useful, because machine learning just kind of takes these inputs and builds some complex inside relationships. Also, there is something about the p-values, that when we build this linear regression, I check p-value for each of the variable. Basically, again, this is something what is simply not really realistic assumption. And what we really want to do, we want to do feature importance that shows what feature are predictive out of sample. And p-values, it's about in-sample justification. What we said, there is like different types of overfitting. Overfitting for the test set and for the train set. And we talk about overfitting for the train set. Basically, we take data in sample, fit the model, and can predict anything out of sample. And when we're talking about the test set overfitting, it's typical for the trading research. It's like, okay, I take 20 years, I fit some linear regression, and then I take next 10 years and use this linear regression to trade. And if you repeat this process a lot of times, using the same testing set, it's basically, you are prone to such a thing as called like multiple comparison. Basically, you can perform thousands of experiments and you can overfit for the testing set. So basically, it's like a thing that you have repeated many experiments on the same piece of data, so your finding might be not relevant for the whole trading universe. And basically, one of the solutions that again, it is one of the solutions that we might consider as relevant is machine learning. And there is like a nice picture that shows that both for the generative and the discriminative models, when I say generative model, it's a model that potentially can replicate data. So for example, Bayesian regression is a generative model. Why? Because each parameter in the Bayesian regression is a distribution. So basically, from the distribution we can sample, which means we can generate new samples of data. For example, when we fit Bayesian linear regression and both slope and intercept are distributions, we can sample different lines, which means that generative models. And like clear expansion from these models, which are linear, are some non-linear models, which are Bayesian neural networks, for example. If talking about the discriminative models, they're classical models that predict something like 1 point. We take a piece of data and we predict, I don't know, class from it, we predict some continuous value from it. And for example, for time series, we had ARIMA, we had GARCH, and recurrent neural networks are nice non-linear expansions. If we talk about smoothing, we can talk about convolutional neural networks. If we talk about models that do for us some sort of feature importance, PCA as a linear model, and for example, autoencoders, they do this in a non-linear way. So this is just some sort of recap why we even care about machine learning in finance, because classical mathematical modeling has clear drawbacks. I'll check in the chat, and maybe let's for 5 minutes discuss it. So maybe you have some notes to tell. I'd like to see how it's possible to do machine learning in finance without taking big risks in this difficult sector. I think There is no like in finance, unfortunately, there is such a no thing as like no big risks. But I think what's important is when we can measure these risks correctly. So basically, exactly today will be about measuring the risks and measuring the risks correctly. So I think at least you'll be able to evaluate the risks, and when you build, for example, 10 strategies, you'll have a clear picture, and at least you can, if you care about big risks, you can choose, for example, the strategy that has low risks compared to the others. Yeah, slides are awesome, and I'm also a big fan of Lopez de Prada. I have all his books, including this one in paper, so I'm a big fan as well. We have a delay, so I'll wait a couple of minutes till I see the questions. And guys, if you have no questions, just type all clear. Most probably you already have seen all the slides for a lot of times, so we just go further. Applying backtesting on more than 10 years doesn't avoid overfitting. Basically, that's exactly what we're gonna talk today about. Like going a bit like further in our discussion, that backtesting itself it's some sort of really problematic thing, because for example, when you have this 10 years of Apple movements, it's just one realization of stochastic process, right? So basically the Apple price could go in many different directions. And all what we know that, for example, that Apple is a strong company, it's growing, right? And we know that, for example, market in one moment is volatile, another moment is not volatile. So, okay, we can assume that Apple gonna grow, and the volatility in the year of 2020 gonna be high, something like this. But what exact will be volatility and how fast will be Apple grow, and if it will grow at all, we don't know. We just have, that's why we need to, what we really want to do, we want to simulate some scenarios. And we want to backtest not on single time series, but in different scenarios to see how my strategy will behave under different conditions. So that's why backtesting on 10 years, 20 years, it's problematic thing, because it's just one realization of stochastic process. Alright, so now I'm gonna keep going with the recap. So basically on the previous workshop, we saw this kind of problems. We're like, wow, machine learning is cool, let's train some models, right? So basically what I was showing, that we can take a data set of, again, I'm talking about Apple, so it's gonna be Apple prices, and a couple of like features. They're like technical indicators, fundamental features. Yeah, basically we can take this and train machine learning models. So basically, what's the idea? I'm gonna rerun it and go quickly through the code, because this is not the topic for today. I just want to show you from where everything is growing. Basically, we have this kind of features, in sample, out of sample. We normalize them correctly. So basically, I take statistics from the train set, normalize it, then I reapply the statistics for the test set, because basically I don't know what's going to happen in the future, so I have to kind of reapply the statistics. I take 14 days of these features to predict next day price. Basically, this is the prices I want to predict. I build a neural network, which is relatively simple. I regularize it with the dropout. I apply early stopping, so I kind of do everything correct from the normal machine learning routine. I normalize the data without any leakage from the train to the test set. I do to the inputs to the outputs. I apply regularization to the model, both from the model specification and early stopping point of view. I train this model to predict the price, and then let's see what's going to happen. It's training. Basically, after I'm going to evaluate from the mean absolute error point of view, because I want to know what is my error in prediction per dollar price, and what's basically R2 squared. We can consider some sort of correlation. What is the correlation? What we can see, wow, I really can predict in a very nice way price out of sample. Blue line is the actual price, orange line is my predictions. It looks so good. But if we try to run very simple backtest, and backtest is like basically if my signal is -1 and the price actually went down, for example, by 4.6%, I'm winning. And if price goes up and I predict price to go up, I am winning again. And if my signal and the actual price movement is different, I'm losing money. So I'm kind of doing this again. It's some sort of pseudo backtest. It doesn't take into account many things, but at least it allows us to test at least if I can predict something good or no. And we can see, wow, my neural network strategy is actually so bad. Even the forecast looks so good. Basically, this is from where my own personal research in like machine learning finance started. It was like 4 years ago. I trained the model. I saw this nice picture. I ran a backtest. It didn't work out, and I was like, "Damn, why it doesn't work?" And one of the findings that I figured out that I need to fix inputs and outputs, because basically when I talk about normal machine learning, for example, computer vision, pixel always is a pixel. So if it's a green color, it's always a green color, and combination of green colors is always green. But if I look on the right and I check the prices, they're realizations of some stochastic process. So basically, it's like each price in each moment, it kind of means nothing, because it's just stochastic. So basically, what I figure out that when I do this kind of predictions, my model actually learns nothing. My model just learns to predict kind of shifted time series. So basically, my prediction for tomorrow is the price from yesterday. And this kind of findings you can find in many peer-reviewed academic papers and many blogs. And for example, in many cases, models like ARIMA do exactly this kind of forecasts. So I was figure out, wow, that's not good. I need to find better representation of the data. And as you might guess, one of the first ideas can be to apply some sort of more correct normalization of the data and stationarization of the data. And we can use first order difference. So basically we go from prices to returns, and we change both inputs and the outputs. So I want to use as the input not the time series of prices itself, but the first order differences. And what I want to forecast, again, not the price, but the difference of the price. And I don't really want to rerun the code. I'll just show you the results in the notebook. Basically what I did, okay, next experiment, we're taking the same data set, and I kind of wanted to separate this. First, I normalize the inputs the same way, so because I don't want to, I was thinking why I should do this difference. I want to, if I normalize data, it's enough. And also the prices, they have the patterns, and people talk about the patterns, so I just want to normalize my price patterns. But when I do the predictions, you see, I predict the difference. So basically, price in the horizon 1 day from now minus price today divided by price today. So I predict not the price, but percentual difference of the price. So now my outputs look actually converging. But what you can see that the correlation of this model out of sample, I mean, R2 score, I kind of treat it as correlation. So I hope you forgive this a bit familiarity. The correlation is pretty low. Actually, it's negative. We can't rely on this model. But if you run the same backtest, I mean pseudo backtest, of course, we can see that the model, my strategy, performs better than the benchmark. And the benchmark is if I'm just holding Apple stock. So basically, this gave me another idea. So for example, if I actually didn't check the accuracy of the model, but kind of just, okay, I fit it, I see it's convergent, let's run the backtest. And if I skipped this part and just checked on the backtest, I could rely on completely random patterns. So basically, randomly wrong model appeared to be lucky in this small piece of the backtesting, which is, I think, in our case, backtesting is more than 1,200 days is the backtesting. And if I could rely on this model, again, it would be completely wrong, because how can I be sure that in the future this kind of model with this metrics gonna work correctly? So obviously this is the wrong finding. And then I also run another experiment to show again, okay, maybe now I want to use differences for both pieces of data. I want to where I do it. Basically, as you can see, I turn all data into this PCT change. It's pandas function that turns your row time series into percentage changes. Basically, all my data will look like this. So it's kind of stationary. It's all centered around 0. And okay, maybe the variance is changing over time, but at least it's centered. And basically, I can do the same. My inputs now are, you see, columns session. This is my inputs, and they're turned into percentual changes, so they're stationary. My outputs of the price, again, is such change. I train them the same model, the same regularization, etc., and train it. As you can see, this model even failed to converge. You see that's like it has some huge outliers. Basically, this model can't do anything. And again, but the strategy again behaves kinda fine. At the end, it's still a bit worse than just holding Apple stock, but the strategy itself works kinda fine. So basically, the finding of these experiments was what? It's that doing normal machine learning, like normal what I would do, for example, in computer vision. I would take my data, I would normalize it, I would regularize the model, split data into train and test when train and test doesn't intersect, obviously, and as you can see, where is it? Here my train and test also doesn't intersect. I separate them temporarily. But if I do this, I can't rely on these results. So basically, the question was, what should I do? And thanks to Marcos de Prada, he is basically giving us some insights what we can do, again from the inputs and outputs point of view, because the model itself is not that important. The problem with the machine learning in finance, and that's what we discussed in the previous workshop, is that the people who are coming from machine learning field, they are used to see pictures, and when in pictures, all the pixels are always stationary. Green pixel is always green. People who work in this, I know, like data from the customers, the customer with this profile is kind of always the customer with this profile. It's not stochastic. And the same about the outputs. But in finance, everything is stochastic, so we need to really prepare both inputs and the outputs in such a way so we kind of reduce the noisy part and maximize as possible the signal part. So basically, that's the idea. And for example, what we've seen today, why machine learning fails. Again, let's also quick look over why our experiments we did were wrong. Again, following Marcos Lopez de Prada and what he is saying as the reasons. Basically, okay, this what he means, like basically Sisyphean work. Basically, you're doing meaningless stuff. You're just kind of repeating the experiments that have no sense, and that's why you're failing. Second, integer differentiation. That's what we're gonna also have a look. Basically, when you do this first order difference, you get the stationary data, but the stationary data has no memory and has no patterns. Second is inefficient sampling of the data, because what we work with this like prices, they're coming every day, but actually this data, if I check price every day, is not really interesting, because I can have a week of super calm situation in the market where actually nothing happens, and I have 1 hour of market crash. And actually, by the amount of information, this 1 hour is much more important than the whole previous week. But if I check just what's happening every day, again, kind of like I get nothing. It's related to the inputs. Wrong labeling. When we just predict price, for example, how price will change in a week from now, it's also not really correct, because you don't make a trade like strictly every Friday. Because, for example, if you see some huge jump of the price on Wednesday, you want to take this profit, for example. You don't wait till Friday, because on Friday the price can go actually down. So we need to do the outputs another way. Also, there is the problem with no identically independently distributed samples. Also, we don't do the cross validation right, etc., etc. So basically, that's what we're gonna talk today. Basically, about cross validation, overfitting. That's a bit more for today. So one of the things that we can consider as the logical next step after this experiment, why don't we fix the inputs and the outputs at least? So this is the classical PCT change, what we saw today. And so you can see what is the stationary between against memory dilemma. The time series on the left has really super clear visual pattern, both from the trend and seasonality point of view. You guys can predict this time series with your eyes without any machine learning algorithm. You just can draw the next season, and you'll be most probably right. But when I give you just the time series on the right, for you it will be so hard to predict it with your eyes. And machine learning is good with the visual patterns, but machine learning is not good with not stationary data. So one of the tricks is to use fractional differentiation. So instead of using first order difference, we can use the difference of order 0.5, 0.7, 0.1. And there is a nice mathematical trick to do it. Basically, it's the series expansion, and when we expand the first order difference as a series, we can basically use the differentiation order d as arbitrary value. And this visualization is really nice because red time series is Bitcoin price, and the dark green is the first order difference. As you can see, first order difference has no information about the trend and the memory and the patterns. But if you do the difference order 0.6, 0.5, the time series still is stationary, but it contains the patterns. The same about the outputs. Instead of predicting what's going to happen after some horizon, 1 day, 7 day, 1 month, 1 year, we want to predict what's going to happen inside this horizon. So that's why we kind of build this kind of box where the upper and lower bound of the box is our take profit and stop loss limit, and we predict not what's going to happen in the week from now, but we predict if inside this week we're going to touch take profit or stop loss target. And also we realized after these experiments that we can't rely on the backtesting. We need to really work on the model first. And basically the key finding is that unless we don't really trust our model, we have no right to do backtesting. One of the ways to trust the model is perform feature importance, because feature importance is a research tool. We have some hypothesis that there are some predictive features. We build the model, we cross-validate it, we do feature importance, and from feature importance we say, yes, I was expecting that the depth of the apple is predictive value, and I see over cross-validation the depth is constantly a predictive feature, so my hypothesis is right. I may try to use this model in the trading. So with these findings, we can train the model again. And basically what we did here, we took the data. One more trick. We use now a bit different model. Basically, instead of neural network, we use Bayesian classifier. Why Bayesian and, for example, not boosting? Because boosting is focusing a bit more like on the, let's say, on the accuracy, but Bayesian is reducing the Bayesian is focused to reduce the variance of the forecasts. And since we are caring so much about the risk and the reliability, variance is also one of the measures of the risks. And Bayesian helps us focus a bit more on this risk. And I was showing that we can take this data set, we can extract some new kind of features. and basically we can run several experiments, since Bagging is a model that basically it's kind of does some sampling. So when you rerun the training, you each time can obtain a bit different forecast, and it's normal because Bagging is sampling pieces of data. So once you sample one piece of data that is super relevant, another time you sample another piece of data that can be a bit less relevant, so you can have different accuracies. That's why I sample it some amount of number of times, so I can get not a point estimate out of sample, just one. For example, here I use MMC, Matthews correlation coefficient, as the measure of accuracy, but I can have the distribution, which also allows me to measure the risk. And I can see that, for example, in this experiment, my mean MMC out of sample is 3%, which is actually in finance is pretty good. It's like you're 3% better than random. And basically my left tail risk is once my model was pretty bad. So basically that's my risk out of, I think, 15 or 25. Let me check. Yeah, I am rerunning my model 25 times, and twice out of 25 times my accuracy was negative. So basically this is my risk of the model. Look guys, I'm even not doing any backtesting now. I'm only checking the risk of the model and care about my financial discovery. And I can say, okay, this is the risk, for example, I can afford. And only after I build my strategy, and actually you can see the strategy works like this, and I also build the strategies from all Bagging classifiers. So I actually can also visualize the risk of my model. And after that, we are going to talk about this metrics today. I can see, for example, the Sharpe ratio of the benchmark of just holding Apple stock is this Sharpe ratio, the Sharpe ratio of my strategy. Even the returns are a bit lower, but my strategy that I built this machine is less risky. You see, it falls much less. That's why Sharpe ratio is kind of higher. And actually, here's a small mistake. I had to do feature importance before backtesting, but again, for the visualization purpose, you can assume I did this before. And I check my feature importance. I see that, for example, my model is relying on the mean close price fractionally differentiated, on the volume feature, on the skewness of the distribution in the prices of the past, which just actually makes sense, where how skewed my distribution is towards going up or going down. For example, if my past 30 days are skewed towards going up, it's some sort of momentum hypothesis, because if or trend hypothesis, if my price is going up, I expect it to go up, so I check the skewness. And also kurtosis, basically the fat tailness of my distribution of the prices in the past, standard deviation, etc. And I can see that a couple of other features are not relevant at all, which is completely fine. And for example, if I take off these features, I can rerun my experiments, and you can see that if I take off some not relevant features, my model, this left tail risk, now the riskiest model I'm going to have is a bit better. It has not negative correlation, but zero correlation. Still not good, but at least a bit better. And we can see that strategy without these not relevant features is even better. So basically, this kind of notebook, it proves that if we do fractional differentiation, if we do Bagging classification, if we extract correct features, if we still, here it's, to be honest, still fixed horizon prediction, so it just predicts the next day, but for now, for us, it's okay. We still can do this. We can, if you want to trade every day, we can do this. Also here we are fixing this IID assumption up to some point, so basically we don't mix. Reconnection successful. Okay, I hope it's okay. Let's now discuss it for a while. Federico is asking, in normalization, your code use a rolling mean or whole training model? I wasn't using the rolling mean, and you're right, because I was trying to show the classical baseline. So I was using just whole training model normalization, like we do, for example, in computer vision. Random forest takes advantage of the memory in the sequence. No, when I talk about memory, I mean the concept of fractional differentiation. So basically, I don't use this green time series as the input and features calculation. I use, for example, blue time series, which has some memory. A random forest is just taking set of features. A random forest that has nothing to do with the memory. I add memory in the input preparation. So that's why I'm saying the models, they're kind of not really important, because what we really care about is right financial understanding of the data. Anything new here? Did you guys already, I don't know if you have followed like previous workshop, so for you guys this information is like completely new, or you already used it, so basically just give me some feedback, or if something is not clear, I'll try to explain it now in some simple words, but I recommend you or to check the book or watch my previous workshop, because back then I spent like I think couple of hours just talking about this. So, and now I'm spending half an hour just giving the big picture. Or if no questions, also let me know so we can go further. So just again, to make a quick recap, what we did here and what we did in the previous workshop, we learned why econometrics is bad. We try to apply machine learning as we do in computer vision, so to say. We saw that it doesn't work. We checked a couple of tricks of De Prado, and we, at least for now, at least on this experiment, on the data from, I think, from 2015 till 2020, I guess. From 2018 to 2020, we made it work, and it seems that we did everything correctly, because MMC's distribution is clear, some metrics and the sharp ratios and clear, feature importance also makes sense, so it looks like we did everything fine. But basically, on the previous workshop, it was a bit shocking for some people that, wow, everything is not like in computer vision. And now for you guys, I'll show you that what we do here is also not everything is as we used to see. So yes, what I want to tell you that even after all those tricks, we still can't trust this backtest. And there are three big reasons why we can't trust it. But we still, everyone in the finance, when is reporting about the strategy, behavior, success, not success, performance, everyone is showing the backtest and compares it to some benchmark. For example, look guys, I can beat the S&P 500. And it shows that I can beat it on the last 20 years, something like this. One thing that I already mentioned, that the prices in this 10, 20, 50 years, the prices could go in any possible way. It is really a stochastic process. And by stochastic, I mean, okay, that maybe we can expect that economy in the United States and the whole world, economy is growing. Okay, but what it means for us? It doesn't mean that our strategy will perform well in any growing way. It just means that, okay, we can assume, and again, just an assumption, that in the long term, the drift, which means like the growth of our, let's say, price of some asset is going to grow. For example, like 3%, 10% yearly. But it's just an assumption. One year it can be 10%, another year it can be 7%. Some year it can fall, but on the long term it's going to grow. So again, it's the stochastic value. The same about volatility. 1 year or 1 month it can grow pretty calmly. Another month it can be very volatile, etc., etc. And this is only like mean value of the growth and the volatility, which are just two variables. And actually stochastic processes, they can be much more complex. For example, we all know that the price can jump or fall very drastically. And for example, if you talk about geometrical Brownian motion that takes as input this drift and volatility, we can't really simulate the fall downs. So for example, there is jump diffusion process that has 3 new variables. It has the frequency of such jumps, up or down, then it has the mean value of the jump, which basically up or down, and the volatility of the sizes of these jumps. And basically, such a process, if we assume that our economy can fall drastically or jump drastically, we need to assume 3 additional variables. And how do we define these variables? We don't know. And in reality, these models, when we start thinking about the market can behave like this, like that, it can self-revert, it can be flat for a long time, etc., etc., we can add dozens of variables. And the price could go any possible way. That's why relying on one realization of such a complex stochastic process that has so many degrees of freedom, it's simply not correct, because if the price could go a bit more volatile, maybe your strategy already fails, because your machine learning model has been fit on the features that are not taking into account the volatility, for example, or something like this. And you already would fail. Even the economy would grow, even the jumps would be the same, but the volatility is different and your model is wrong. Or for example, the opposite, you trained your model only on the very volatile market situations, but in the future it will be very calm, because we're going to go to the green economy and we are waiting for 20 years of prosperity and clear growth. Your model is going to break, and that's the main problem. No, sorry, it's one of the 3 problems. Second problem is the backtest. It doesn't explain the financial discovery, because it's very easy when you see the performance in the past. You can say, you see, in 2008 it was a crisis, so in the crisis my model performed better, as you can see. Or even if your model, for example, kind of fell down with the crisis and then recovered, you can say, you see, my model is correlated with the market, or something like this. But this has nothing to do with how your model will perform in the future. It doesn't explain anything. You're just kind of trying to justify patterns in the past, which actually all people in the econometrics do. They observe something in the past and they're trying to explain it with correlation, with linear regression, or with some stories. So basically, you look on this backtest and you're trying to kind of justify your performance. And you're saying, yeah, AI behave like this, AI, because AI is following the market, because they included the trend features or something like this. So again, this is another problem of classical backtests, and that's why we can't really rely on it. And last thing, it doesn't allow us forecast performance and the risks, because again, how it performed in the past tells us nothing how it's going to perform in the future. And talking about the risk, I mean not only like market risk or portfolio risk, because for example, there is risk of diversification. For example, you can measure, if you have a portfolio of 10 assets, you can measure how good you diversify, right? And this is the risk of your portfolio. Or you can measure the volatility of your strategy, and again, this is the risk of your portfolio, or the drawdown. But what is the risk of your model? And how to forecast the risk of your model? Basically, this question that the benchmark doesn't answer to. Or how to forecast the probability of overfitting. Because also you can assume that in some market situation you don't overfit, in some market situation you overfit. How to forecast this risk? Again, this is also not clear. So that's why the classical, this backtest spreadsheet with the typical PDF that fund manager shows you. There is a graph with two lines. One line is some market benchmark, let's say S&P 500. Second line is the fund performance. And below that there are two tables. First table is Sharpe ratio, expected return, etc., 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 all calculated in the past. And second piece is like, this is my how it's called. This is my assets that are contributed to the performance. So basically, you can say some maybe pie diagram that's saying, okay, I hold 30% in the American tech market, 50% at the bonds, and something like this. So this is typical picture, and I hope it's more or less clear that this picture is not relevant to forecast the performance. And we as people who do some sort of modeling, machine learning, we actually are interested in performance in the future, in the out of sample. So that's what I want to talk about. And first thing I want to talk about is advanced metrics to track. So even if you have the single backtest, okay, let's assume we have the single backtest, but we can see much more from it than just Sharpe ratio or something like this. And if we're talking the machine learning models, first of all, they're data and model risks. Because, for example, if our strategy is some sort of, let's say, portfolio management, so basically we just take some assets and we, every month we are checking basically the prices of these assets, and we check the correlation of these assets, and we rebalance our portfolio based on this. It has, in a way, no model, because we don't model nothing. We just kind of look at the market and act accordingly. And there is no data risks, because data is just prices in the past. So basically, in classical portfolio management strategies, if you talk about like very really baseline, like Markowitz portfolio optimization, there is no data and model risks, in a way. I'm simplifying situation, but it is like this. But in the machine learning scenario or any forecasting scenario, there is data risks. And the first data risk is do you generalize to the market? Because what we did, for example, in these experiments, we took, for example, Apple price, and we ran a backtest on the Apple price. And we explained, for example, okay, the mean value of the fractional differentiated time series, the skewness of this time series, and the volume feature are important. But if we really want to find a financial finding, we want to see the same features be relevant to Microsoft, to Oracle, to Amazon and other tech companies, to Microsoft, because this is the market and they all go together. Maybe not in a linear way, but at least we expect to this financial finding to generalize to the market. Because if other companies are driven completely by other features, it's a question to us, is Apple really so different? Because what we really see that, for example, when the tech market falls, Apple falls as well. So we need to generalize, and this is the data risk. If we took just Apple and we didn't take the data from another similar assets from the similar market. So basically what we really have to do, we need to run our experiment on the top 10 competitors or similar companies to Apple, and we want to see more or less the same performance and more or less the same feature importance. And also in the data, there is a risk of being feature exposure. It's a bit more related to the model, to be honest. I think I had to put it to the feature exposures goes to the model actually. But we also don't want our model to rely on a single feature too much. Because markets, we know from the evidence that they have different regimes. And for example, if I rely all the time on the, let's say, skewness of the distribution of the past 30 days, it literally means that we are relying on the trend. If the price is skewed towards going up, we expect it in the future to go up. But that's the like market growth regime. And if we see that feature importance of this skewness feature is so high compared to the other, it means we're exposed to one factor. We're exposed to a single feature. And actually that's what we want to avoid, because we know that the regime can change any moment. And basically we will fall together if there is the market. And there are actually several strategies to deal with this. Some practitioners, when they see such situations, they can even remove the top performing feature. And why they do this? For example, we see that this skewness is the top feature and we just remove it. What we will see on the backtest then, on the results, our model will be less accurate. And that's true because this feature is so important, and on our past data, the market was growing. So it's kind of obvious to see that if we're kind of a bit exposed to this growth factor, we were performing so well. So on the backtest and on the past accuracies, we will see really not really good performance. But we can be sure that in the future, we can rely on this model a bit more. Because, for example, if the market falls, but we are not exposed to the growth, and we are relying, for example, only on the volume, only on the fat tails, or some other features, there is much higher probability that we don't fall with the market. And for some practitioners who care much more about the risk than about performance, this is really good trick to not to be exposed to something too much. This is the data risks, data and the feature risks. And also the model risks. Basically, we want to, as I showed you, we were like drawing the distribution of MMCs, of matrix correlation coefficients, which you can see the formula. To me, MCC, it's kind of like nice alternative to the accuracy and F1 score, because you see, it's calculated from the same constituents as the F1 score or the or accuracy, basically. But it shows us like it's kind of like alternative to correlation, because it shows us how much you are better than the random. And I think this is much more useful feature to track as an accuracy proxy. Basically, that's the model risk. And the model risk, we can track even how this accuracy changing over time. If our model is stochastic, we can check, like Begin is stochastic model. We can check the distribution of MCCs and how they're changing over time. And this way we can check the risk. And for example, if our model has some fat left tail, we simply don't work with this model, because we don't want to be exposed to the model risk. We better make the model a bit deeper, or we add new features, etc., etc. And second is model certainty, because we also want our model to be certain enough, and that we don't want to be exposed to the risk of our model to, because when we see that our model is uncertain on out of sample, it means that the market is kind of changing over time, and now for our model everything is completely new. So this is also the risk that we don't really want to be exposed to. Let's discuss these two risks a bit more. What do you think about it? Does it make sense to you, or something what, I don't know, is different or doesn't make sense maybe? I'll wait like 30 seconds for the questions, and we'll go to the next group of risks, metrics, whatever you want to call it. Yes, examples, of course, examples are kind. Basically, I'm not going to show just slides. Everything what I show you on this slide is going to be followed with the pieces of code. So I'm just, like showing things step by step. Let's go deeper. Okay. Next block of statistics are efficiency. And normally in finance, what is efficiency? It's the risk-adjusted return. And the classical representation of risk-adjusted return. Okay, sorry, there's one more question. Maybe it's a silly question, but it's possible that some features change over time or get a different weight. Yes, of course, it's possible, but there's a problem. We need to explain these changes. It's like if we see that our feature importance is just jumping over time completely randomly, it's like it makes no sense. Because even, for example, when we see that in the healthy market situation when it's growing, we kind of can rely on momentum, we can rely on value. But for example, even right now in this COVID situation, we can't really rely on the momentum or value as a predictive value. Today we look at other features. We look, for example, on which sector, if the sector is affected by COVID or no. We can track some even like monetary policies of the governments, interest rates, etc. That's what today we look into to forecast the price. Because the situation is not stable, it's risky, so that's why we look on other features. So of course features can change. I can tell you even more, over time we can add and introduce new features, but we need to be able to explain them as finance experts. And if we see, for example, that in 2020, for example, interest rate and the sector became more important than momentum compared to 2018, we need to be able to say, it is like this because of this. So that's the thing. Yeah, so basically risk-adjusted return, it's normally some sort of like return, and return is basically how much we earn divided by some sort of risk. And the classical Sharpe ratio is if we take expected returns, basically we calculate the mean value of the returns on our backtest, and if our backtest is going up, this mean value will be positive. We subtract the risk-free rate because we want to earn more than if we put money to the bank, and we divide it with, for example, on the volatility of the market. Or we can divide it on the maximum drawdown, or we can divide it on the value at risk. Basically, the notion of risk can really change a lot. And then we multiply by the square of the number of days in the year, working days, but this is just like adjustment for to call it annualized Sharpe ratio. The new thing that we can add here is, for example, when we calculate the Sharpe ratio and, for example, we calculate the mean of these expected returns, it's clear that this, first of all, the market, because we want to beat the market, so the market is some sort of benchmark for us. The price of the market, the returns of the market, they are not really distributed normally. So we normally have some fat tails. This is our risks. And as you can see, the Sharpe ratio also doesn't take into account how much we actually overperform. It doesn't take into account the underlying market. It's like, for example, when we say that the market has Sharpe ratio 1.5 and the strategy has Sharpe ratio 1.7, yes, we can say that Sharpe ratio of the strategy is better, but it doesn't take into account the actual distribution, and it doesn't compare two distributions and their fat tails, etc. So that's why we actually need some new measure that first of all take into account fat tails and skews, and also takes into account the benchmark. So probabilistic Sharpe ratio is one of such measures. Basically what it does, if you look at the formula, Z is basically cumulative distribution and we take this parameter. SR is Sharpe ratio of the strategy, and SR star is Sharpe ratio of the benchmark of the market, for example. And obviously, what is we see in the upper part of this formula? When this probabilistic Sharpe ratio is growing, the more is the difference between our strategy and the benchmark. Obviously, the PSR gonna grow, and T is numbers of days of the backtest. And also, the more days is our backtest, the more reliable it is. So the more T we have, the more grow will the PSR. And also the T, as you can see, it's squared, so it is not like growing like linearly. And what will penalize, what will make our PSR worse? First of all, we see that below we see 1 minus, oh my god, I forgot how this calculator is called. It's not mil, right? It's gamma is, yeah, it's gamma, of course. Gamma 3 is the third statistical moment. A gamma 4 is fourth statistical moment, which are skewness and the kurtosis. As we can see below, we multiply gamma 3, which is skewness, multiplied by the Sharpe ratio of the strategy. And this gamma 3, gamma 4 are statistical moments of our strategy. So if we see that gamma 3, which is skewness, is positive, so which means that our Sharpe ratio is kind of going up, right? And basically we kind of penalizing for negative value of the positive skewness. So basically, the higher skewness we have, the higher will be PSR, which kind of makes sense because we make basically we add in the skewness, positive skewness to our formula. And as you can see, what we're gonna penalize for is for the fat tails. So basically, the fatter tails we have, which is the kurtosis, the fourth statistical moment, the less reliable our Sharpe ratio should be, right? So basically, as you can see, this formula completely makes sense. It probabilistic Sharpe ratio, it is increasing Sharpe ratio depending on the more observations you have, the higher the skewness of the backtest is, and the more Sharpe ratio of the backtest is higher than the Sharpe ratio of the benchmark. And it's penalizing and our value based on the fat tails. So that's what's called probabilistic Sharpe ratio. And I think it's a really interesting measure. Second thing is deflated Sharpe ratio and what it does. Basically, as we discussed, there is another problem with the backtesting. We can take the same piece of 20 years of Apple movements, and we can try many different things just to fit this 20 years of Apple stock price. And basically, this way we can be in a situation that there's statistics. There's a concept of like multiple comparison bias. I hope I call it right. I think it's called multiple comparison. It's like the more you experiment towards some findings, the higher is the probability that you're going to mistake. Because the more you repeat some experiment tweaking the parameters, the highest probability that you're going to mistake. In our case, that you're going to overfit. So we also want to penalize our Sharpe ratio for this multiple comparison thing. And this deflated Sharpe ratio, which is basically the formula below, is the long one. You can see it is penalizing for the variance and for number of trials. And basically, there is like some. To be honest, I didn't dive deep into the mathematical sense of this formula, but basically what it does is penalizing for the number of trials and the variance. And the more variance you have, and the higher number of trials and the more variance you have, the less reliable is your Sharpe ratio. And also there is another addition to the Sharpe ratios. It's some sort of smart Sharpe ratios, and this smartness is our bias we want to involve. For example, we know that the data is stochastic, right? So basically, our benchmark is some stochastic time series, and our backtest or strategy also some stochastic time series. And what we don't really want to see in our backtest is some weird patterns. For example, if our backtest is cycling growing up, because if our best backtest is kind of in the cycles, it has some seasonality, it's super weird. Because if we're modeling our data, we actually need to model the seasonality as well, so we can exploit the seasonality. So basically, this is the weird pattern that we don't expect to see. Because if we see such patterns, it means that we're doing something wrong as well. So one of the ways to make some smart Sharpe ratio with our smart biases, we can penalize for the autocorrelation. Basically, if we have some patterns, for example, we can measure these patterns as autocorrelation, and this is our risk. So we divide our expected return by volatility as one measure of the risk, and multiply this volatility by autocorrelation penalty, maybe with some lambda parameter. So basically, this is the way how we can improve a very classical notion of risk-adjusted return. So basically, we want to take into account the distribution. We want to take into account the benchmark. We want to take into account multiple comparison, number of trials we do, and we want to take into account some smart biases that we have, that we know about the market. That, for example, if there is some seasonality, we don't expect our strategy to be seasonal. We want to exploit it. So that's what we want to penalize for. Let's discuss it for a while. Do you guys have some questions? Again, I will show all of this in the code, so don't worry. Or if everything's clear, at least for now, just say OK, and you'll go faster to the code. Go to the code soon. You see, just one more slide and the code is coming. Alright, if no questions, then I'll just go through this slide. Basically, there's also one group of the statistics that at least Marcos Lopez de Prado calls it run statistics. Basically, runs, it describes, how to say, basically not the overall distribution, but actually some patterns inside the backtest. So basically, if data and model is about some fundamental discoveries, efficiency statistics is about overall distribution, and runs is about some small details into the performance. So basically, first such metric can be information ratio, and basically, as you can see, what is information ratio? It takes the difference, positive difference between returns in the benchmark, and divides it by the variance of these positive differences. And basically what it does, I mean, positive of course if we are beating the market. So what we're expecting to see is that we want to have some constant and nice outperformances of the market that are exploiter have some, for example, some constant variance. So basically you want to see that when we go up, it's not some random pattern. Basically you want to see that we have consistent information, external information about the market, so we can beat the benchmark. And this is what's reflected in this formula. Also, there is a nice thing that's called minimum required track record length. Again, basically this is something what is built on the idea that we want to measure how many days we want to backtest our backtest given the skewness and given the fat tail. Yeah, so basically, as you can see again, if our Sharpe ratio is positive and the skewness is high, it means that maybe we can really believe this strategy kind of a bit more, so we don't need to look, for example, for the 10 years of this strategy, because even on the 5 years it's enough to see that's good one. But if, for example, it's volatile, if it has fat tails, we actually better see 10 or even 20 years of performance of this strategy before we are sure that we can actually trade on it. And that's why this is the track record length we want to see. And also there is drawdown and time underwater. Basically drawdown, it's kind of clear how deep we can go low, and basically what is the lowest point of our trading strategy, and how long we stay this low before we get back. So basically this is something what you even don't need a formula to describe. It's pretty obvious. Drawdown is how deep you can go low, how low you can go, and time underwater as how long you're going to stay that low. Okay, some questions maybe before the code. Yeah, like in the pharmaceutical trial, the more tests you make, the higher is the chance that you get good results by the chance. Yeah, basically that's the idea. I'll start the notebooks, and meanwhile I'm ready to answer the questions. If no questions, guys, because I see you're 16 here, so please just kind of let me know. So if I don't have to wait, just say no questions, and this way will just go faster, because maybe everyone is just bored. Okay, no questions. Then let's go through the code, because I think that's the most interesting part. All right. Basically, today I would like to show some examples using the public stocks of the banking companies. Why banking companies? Because this way we will at least, maybe not like super completely numerically, but at least we will kind of check how we can generalize to the market. So if we work only with banks, for example, only with American banks and only with the European banks, at least this way, you know, we're like kind of like can check how much we generalize to the market. Let's start with Deutsche Bank. And we can use the library called Yahoo Financials. We download the data. You see I was running the experiment like 1 month ago till the August, but doesn't matter that much. We format the data, and basically I think you all know how the financial data looks like. So basically here, nothing new at all. Then, since we already know that we better use some fractional differentiation, I use the Neurons Lab library. Basically, I use the parameters, I use D, so basically my parameter of fractional differentiation is 0.7. And as you can see, my close price returns, and exactly from this time series I'm going to extract the features, is look like this. So it's stationary, but still it has information about the trends, about the patterns. So kind of this is the idea of the fractionally differentiated time series. And I'm going to extract different features. There are some features in the Lopez de Prado book. I'm not gonna dive so much into details about them. Basically, they're estimating some sort of, again, non-linear behavior of the market. Let's just consider it like this, because if we start to learn some new features now, it's going to be too much. But I want to create three groups of the features. I want to create classical statistical features, which is basically I'm taking this time series, take some piece of it and extract statistical moments, autocorrelation, etc., etc. Then I have this cool de Prado features, and I want to have technical indicators like RSA, etc. Basically everything what traders do. Yes. Why I want to split them into three groups? Because this way we can kind of study what group of features is the most influential. We can actually answer the question if we can explain anything with the technical indicators, if Lopez de Prado is correct, etc., etc. We will do fixed horizon price prediction just for the next day, just for the simplicity, because I don't want to do complex backtesting. I just want to do kind of really stupid every day. I do the forecast for tomorrow and trade based on this. I know this is kind of stupid strategy, but at least it's easy to evaluate, you know. And the historical window will be 14 days, because I expect that based on last 2 weeks, we can predict something for tomorrow. Maybe too longer, it's too much, because it kind of mixes too much with the past patterns. Too short, maybe not enough, and too short will be not enough to calculate statistics reliably. Again, these all are the hyperparameters, so they can change. Basically, we want to optimize these hyperparameters. So here I extract the technical features from the library TALib. And as you can see, they look like some volume features, momentum, stochastic momentum, blah, 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 blah. As you can see, they have some warm-up period, exactly this like 14 days window. So that's, hope you understand, it's okay. Then I extract, basically I take a subset of these features, because I want to look at about the volume. I want to look at the volatility, I want to look at the trend, and I want to look at the momentum. So basically, I can, even inside the technical features, I'm selecting some groups, so I can, as the financial expert, I can at least like understand what it means. This about the trend, this about momentum, this about the volatility, this about the volume. Okay. This is the de Prado features. You see, some of them look just on the close, some look about some disparity between close and volume, between high and low price. So this is the Prado features, and this is the statistical features. Basically, as you can see, I take statistics: minimum, maximum value, mean, standard deviation, skew, kurtosis, and autocorrelation. And you see, I call these features fit new. So my feature columns will be these columns. Then I do rolling window normalization of this data. So basically, because now if I plot this data set, I think I should even, sorry. You see all the data have completely different range. So basically I want to normalize them, but now I want to normalize them also based on some short piece of historical statistics. So I iterate over my columns, and each of one I normalize in a rolling fashion. So I subtract rolling mean, divide by rolling standard deviation. And this way I obtain my normalized data set. And now, as you can see, all these patterns, okay, this is the close price. This is something like what we don't want to normalize. because it will even, the close price even will not be the input in this data, but all the other features are in a nice range. And what here we're gonna do? Here we're gonna predict the price difference for the next day. Here is some method I do, because you see I still here, when I iterate over the data, I take some historical window, which is historical window of the past 3 days, because I was experimenting, because okay, I extract the features and normalize with the 14 days window, but I was thinking, for example, to predict the next day, I might take the values of the last 3 days. But actually I realized later that I can take even just the features from the last day. So basically I will take the last observation. Basically what from today features, I predict tomorrow features. Basically that's what it does. No magic here. And I split the data. Basically I'll take for experiment 5 years to train, 5 years to test. This is just the first experiment. Don't worry guys, we're gonna make this experiment more realistic. I'm just showing now that we do like this. We split it, make a data set. We train the same model as I showed it before. It's a basically Begin trees classifier. Now then first I want to check the MMCs if they're good enough. Yeah, it takes some time, so I think I'll just... We can see that, okay, the average MMC is 2.5%. There is some risk here, but okay, let's say we neglect this risk. Let's say. We check our strategy. It performs like this. We can see that it's performing actually not that well. And if you remember that now we want to evaluate our cool features. Okay, so visually it doesn't perform well, but let's calculate all the features we discussed before. So basically we have, again, in this library ML FinLab, we have sharp ratio, probabilistic, deflated information, minimum track record, drawdown. Basically, that's what we saw on the slides. And also the smart sharp ratio that penalizes for the autocorrelation. Let's just calculate these values. So we see that if we calculate the sharp ratio of the benchmark and the smart sharp ratio of the benchmark has 0.14. Kind of makes sense. It's like it grew a bit with such a huge drawdown, so you know. And the smart sharp ratio is a bit low, but not that much because it's not really autocorrelated, so that's why there's nothing to penalize for. And the strategy has this low sharp ratio. And if you calculate probabilistic sharp ratio, basically it gives us the probability of our strategy sharp beating the benchmark sharp. It's kind of obvious for us that it's 0. It can't beat the strategy by any means. And if I want to calculate deflated sharp ratio, again, here I didn't do numerous trials, but just imagine, again, this is an assumption for today's lecture, just so we can calculate the numbers. Imagine this, that bagging what we do, and that we did this multiple samples. This is our multiple trials. Basically, I'm rerunning the bagging classifier in hope to get good results. So basically, it's some sort of multiple comparison. So I take my bagging results, and I see even by the bagging results, also the probability of deflated sharp ratio being like it's 0. So basically, by no means I'm beating the benchmark. Information ratio is even negative because I'm underperforming the market. And minimum track record length, okay, it says 13 days. It's like, it's 13 days, it's enough to see that, that my strategy is not good. So basically, that's the results. Let's try to do the same. Again, I want to make a note now. What I'm doing here right now, it's not fully correct. Basically, I had to stop here, do the feature importance, and only after run the backtests. Here, I did not correct thing. Basically, I check the backtest, and only after I am trying to fix the feature importance. But to do it fully correctly, I had to do feature importance before the backtesting. So I'm just kind of showing you that I had to do it a bit differently, but for demonstration purpose, first it will be okay. I calculate the feature importance based on the SHAP classifier. And for example, what we can see. That top feature is minimal price. The Prado feature, the Prado features, and then the top. Then go and start volatility, autocorrelation, skewness. What I can see, basically, what can we do here? What I did here in the experiment, I am removing top 3 features because these features, for example, I don't understand them. I want to remove them. And I want to remove the least 3 features. So basically, I don't want to have big exposure to 2 good features, and I want to have exposure to super bad features. So basically, I'm running my experiment, but now I create a dataset with important features only. And let's recalculate the numbers. Yeah, I'm running it on the MacBook Air. I think it's 2018, 17, so it's not super good. But what we can see is, you can see the MMCs already have no negative factor. Basically, if here we could have some MCCs, I'm calling them the MMCs, but of course it's MCCs. So sorry for this. They have some 0 or negative values. Now I don't have such values. Basically, even the worst performance out of sample still is better than random. And as you can see, my strategy actually is a bit, but better, or no? Let me check. Yeah, a bit. What was the Sharpe ratio of the first strategy? It was minus 0.032. I think I'm doing something wrong here. Strategy return. Of course. Wait. I need to change something else. Yeah, and Sharpe ratio of the new strategy is at least positive. It's still worse than the benchmark, but at least it's already positive, which means that our strategy performs at some point better after we removed some features. And see, at least in both cases, the drawdown wasn't that big. Sorry guys. Basically, yeah, I'm showing everything correct. Here is the benchmark Sharpe, the Sharpe of the first strategy, the Sharpe of the second strategy. We can see that after we did feature importance, we performed better. And the probability of the second strategy based on the important features being better than the first strategy on the not important features is 1. So basically, this was our first play with this metrics in a bit not realistic scenario. Not realistic because basically what we did, it's not like a real backtest of trading. We took like a couple of years here, couple of years there, made some estimate. It even doesn't take into account the last 10 years of the market. So this is something what for us just to play with. What I really wanted to show as a bit more realistic scenario of the training will be the following. What I want to do, I want to define a couple of more hyperparameters. Basically, what I wanted to do, I want to have following scenario. For example, every 3 years, I am taking this model, run it on these 3 years, do the feature importance. Let's say I am sure that this model performs well, and I use this model to trade for the next 1 year. I track this 1 year as my piece of a backtest, and then I take again new previous 3 years train it, do feature importance, train again for a year, put this year to the backtest, and I go like this at this. Year by year, I am taking last 3 years, train, trade, and do like this. Of course, these 3 years of training, 1 year of testing are just the variables. Of course, I need to find them via hyperparameter optimization. Of course, I know they're not optimal, but I hope you understand the idea. That's why I call it retraining and calculation of the metrics. So basically, I want to simulate more realistic scenario. Like I have my 20 years of data, and I'm kind of going step by step, retraining, trading, retraining, trading. And basically, this is something what we can judge a bit more fairly, I would say. I will go through this, and after we'll discuss it and I'll answer the questions. Here also I created a couple of more routines, like basically, so you can see for metrics calculation or feature importance. So basically here is everything a bit more structured. I think let's take C is Citibank ticker. Now let's take Deutsche Bank, so we are consistent. I see I do the same. I have the same fraction differentiated time series, the same hyperparameters of window, input window. I told you one because I want to take like from today predict tomorrow, from today predict tomorrow, nothing else. I calculate all the same features. I create my data set, and as you can see, the same routines for training my Bayesian classifier. And what I do here, I take 5 years for training, 3 years for trading, and I roll like this from the year 2000 to 2021. It will take some time to evaluate it, because I'm kind of like rolling. And I want to, while it's running, I want to go a bit through the code and talk a bit about it. Yeah, so basically what's happening here. From year 2000-2005, I'm gonna take my data, and what I'm gonna do, I'm gonna calculate important features. I'm gonna run 2 experiments. One experiment without important features, and second experiment is with important features. So here in the first experiment, you see, I'm just looping through these years, taking 5 years to train, 3 years to trade. I create these data sets, I calculate my MMCs and predictions, I calculate my strategies, and I simply save the results. And I save everything what I want to track. I want to track my returns from my algorithm. I want to train returns from the benchmark, and the benchmark I consider just the market value. The dates for the visualization, I save my accuracies, I save my predictions from the model to evaluate certainties, and I save my feature importances because I want to check how feature importance changes over time. And basically, that's what's running. After that, I'm gonna concatenate my returns, predictions, and draw them. And then I'm running the same experiment, but as you can see, I'm doing calculating important features, and I'm using these important features to trade. And then I'm doing the same. And after first we're gonna see some visual pictures, and then I'm gonna calculate metrics, compare the strategies, compare them to the benchmark, and this way we can do some judgments about our strategy. And calculate all metrics, you see, I think I duplicated the code, I guess, right? Yeah, this one shouldn't be here. Basically, what does metrics calculation? Basically, it's all the same. Benchmark, Sharpe, strategy Sharpe, probabilistic Sharpe ratio, deflated Sharpe ratio, information ratio, minimum track record. And basically draw down, and then I just add the things to the resulting dictionary, because I want to calculate show it's a dictionary. And yeah, basically this is the metrics about the strategy, this is the metrics about the model, and also will visualize feature importances to see the metrics for the data risks. Guys, excuse me, I'll go out for 2 minutes. Well, anyway, the code is running now, so meanwhile, please ask me the questions. I'll come back in 2 minutes. I want to refill the bottle water. All right. What I see in the chat. Isn't better to take price average of the day instead of the only close price? Again, I am taking like a close to close prediction just for the simplicity, because again, for the simplicity, I know that forecasting target could and should be done much more smart, much more better. We also not taking into account, for example, slippage, transaction costs here. Again, let's focus just on kind of the prediction side, because we will always be able to discard the strategy because, for example, the prediction costs, transaction costs, or for example, of slippage or something like this. But even within this experiment, we want to find the financial discovery. Basically, the discovery we are trying to do right now, we are trying to answer the question: can we take market prices, extract some statistical factors, not fundamental factors, not alternative data, just statistical factors from the prices, and get the edge over the market based on this? That's the discovery we are trying to prove or disprove now. Can we see how the important features have been changed over each 3 years? Why is 3 years? Can be some metrics to know that retrain is needed. Again, guys, this 3 years, 5 years, I choose this numbers kind of randomly. We need to find this value during hyperparameter optimization. Basically, maybe optimal is 4 and 2 or 7 and 1. I have no idea. I just chose it because if we're gonna run hyperparameter optimization now, it's gonna take hours or days. Especially on my MacBook Air, so that's why we don't do it. Of course, these numbers are random, they're not optimal. Can be some metrics to know that retrain is needed? Yes, you can check how accuracy of your model is degrading from time to time, but also it can be not fully correct because regimes are repeating, etc. What I see in practice that people are just kind of retraining constantly, just for example every year, and they find this number of years during the hyperparameter optimization. Or what people do, people are trying to find the regimes. For example, people say, okay, there's 3 regimes on the market. They train the model on these regimes, and then they're trying to identify which regimes we are in and use the model for that regime. And when, for example, regimes can be stable, volatile, and unpredictable, something like this. And then, for example, when we see that we're in the volatile market, we use the model for volatile market, and this time we're gathering more data about these regimes, something like this. But I'm sure there should be another strategies to do this. Okay, so this is the strategy for Deutsche Bank, right? We're running for Deutsche Bank, I suppose. Yeah, for Deutsche Bank. And we can see that if we do this retraining over time, our machine learning strategy shows pretty nice performance. So basically, if we retrain every 3 years, we take 5 previous years, train on them, and use 3 years to trade. Seems like it works. Let's check what happens if we do with the feature importance. This feature importance can give us feature importance. I mean that we use for machine learning model only important features, and by important features I mean removing bottom 3 features. It even works a bit better. So removing some non-significant features helps. But this is just the pictures, right? So basically this is the pictures on a single backtest. Let's run the metrics. And first set of metrics is comparison of the p-tests is the market data, Deutsche Bank performance, and the returns of the first strategy, which is the orange strategy. And we can see that mean returns for benchmark are negative, for strategy mean are positive. Benchmark sharp is negative, strategy sharp is positive. Both probabilistic and deflated sharp ratio are positive. Information ratio is pretty high. Minimum track record is pretty low. The drawdown of the benchmark is 165% of strategy, around 90%. But actually, to be completely fair, first we needed to check these values, right? And because first we want to be sure that model performs well, and then that strategy performs well. So the mean MCC, sorry guys, I don't know why I say MMC all the time, because I listen to hip hop and I call everything mean MC, I don't know. So mean is pretty high. Standard deviation, so basically check a distribution of MCCs, is 0.3. And also I like to calculate some sort of MCC sharp ratio. Basically I divide MCC mean by MCC standard deviation and expect it to be higher than 1, obviously. And it's like this. Model certainty is better from the uncertain by 3%. So uncertain, which means when model says like 0.5, which model is uncertain. So average certainty is 3% on one other side, which is actually not very high. But still, you can see it's enough to beat the benchmark. Now what's interesting, let's forget about the benchmark and let's compare orange strategy to the green strategy. So basically, let's see if our hypothesis of taking off bottom 3 features is actually statistically significant, because that orange strategy is better than the blue strategy is kind of clear. It's clean visually and the numbers confirm it. But let's compare orange and green. Is actually this boost statistically significant or no? And what we can see, that strategy sharp is a bit higher, yes. And actually, both probabilistic and deflated sharp ratio are confirming it. Information ratio is not that high, but it says that indeed there is some useful information. But compare the minimum track record length. It's very high. So basically, to confirm that this is higher than this, we actually need to wait longer. And what else? Basically, yeah, drawdown is a bit smaller, and the MCC sharp is a bit higher, but the certainty is a bit less. And it's kind of why certainty is less, because we removed some predictive features, so our model became less certain. But still, I would say that these two metrics are showing us that we did a good job here, at least for Deutsche Bank. And also can check how this time we basically had 5 periods of 3 years. You also can check how the feature importance is changing over time. Again, this will require a bit deeper understanding of the features. So basically that's why I will not dive into this particular risk measure right now. I just want to show that we can do this. We can draw the feature importance for each feature over time, over each piece of backtest. And basically we can see that, for example, these 2 blue lines, this volume, they jumped here. These cyan lines, they are for volume and autocorrelation, they jumped here. Basically we can say that these jumps are telling us that this feature can be reliable, not reliable over time. And if we aiming for the performance, we obviously need to kind of add this feature. But if you aim for the stability and we don't want to be exposed towards some features, we need to remove these features. So basically, again, this is about feature exposure. And we see that indeed we have some features that we... Low mic scratching against the beard. Okay. Sorry. I don't know. I'll try not to move too much. Sorry. Yeah, and basically, I was showing that if you aim for the stability, we might want to remove the top features and stay with the ones who are a bit lower, but at least stable. So this is the experiment with retraining. But okay, this is Deutsche Bank. And one of the risk measures we mentioned that we want to generalize to the market. I'll be shamelessly showing my blog post now, not because, just because, guys, I want to save a bit of time, because when I was writing the blog on this topic and I compared many different banks. So basically, now we want to test if we got lucky with Deutsche Bank performance, or we can consistently winning for other public banks and we can expect the same performance. And basically, I just don't want to rerun all the experiments on like 5 or 10 banks because we simply don't have that much time. So I'll just show you the pictures from the blog and we will judge it based on this. Basically, yeah, I'm just kind of repeating the experiment. Deutsche Bank, you already, guys. Why it's not loading? Okay, yeah, now it's loaded. Basically, this is everything we already have seen. This is we just have seen it as well. And let's take Bank of America and see that already with the first random bank I picked to train and evaluate the same strategy, everything the same. I just here changed the DB to Bank of America and just rerun it. Literally the same. It already fails, both by the visual and numbers point of view. Wells Fargo fails horribly. Citibank. That's interesting because Citibank actually showed overperformance of our strategy over the benchmark. But if we start to check probabilistic Sharpe ratio, it's 1, but deflated Sharpe ratio is 0. And what it means? That the variance of my bagging models is way too high. It means that this mean performance is not explained. It's like I'm in the multiple experiments trap here. So again, I can't rely on this result. I was having an idea that, okay, maybe American banks, why I can't win with American banks, because Deutsche Bank is a European bank, so I want to try on the European banks now. So I tried Credit Suisse, and it fails. I tried HSBC, and you see HSBC, it works, but I had to check on the Matisse correlation coefficients, which is actually negative. So this positive performance of on HSBC is actually random, because you can see that my model is on average, my model doesn't learn anything, which means that maybe I need to add new features for HSBC or regularize better or add better models, something like this. Dutch Bank, ING, the picture looks kind of good, but look, again, deflated sharp 0, and if I, yeah, so basically deflated sharp is 0, so again, I can't try this, trust this result. So what, guys, we can tell based on these pictures and numbers in this experiment? That all these risk measures are really crucial and important. And basically, if we run this experiment only on Deutsche Bank, and we're like, wow, look, guys, so good, and all that, everything works well, thanks to knowing data risks and market generalization, thanks to knowing model risks, and thanks to knowing things like probabilistic Sharpe ratio, deflated Sharpe ratio, we could actually discard our hypothesis that statistical factors and, let's say, some cool formulas are able to predict banking stocks. And we should consider this as basically as a result of this our experiment. And now let's discuss it, because this is really interesting. This is really important result, so I think here we should discuss at least something, because I guess it's clear, more or less, at least I try to show it clear way, but what do you think about it? It's like, or maybe what do you think, what we could do in this kind of situations? Okay, we performed the experiment, and I think it's clear the experiment failed, so maybe what do you think, what should we do right now? Based on what we have learned and what you guys know. All these metrics we get after the backtesting. Is there a way to predict before the backtesting how could be the performance? Basically, this will be the next part, because the workshop is not finished and there will be still 2 parts. So there are some, yeah, this is the metrics kind of like post factum, but this is just basically, as I say, today we're going to talk about 3 things. And okay, basically, no, where I show it here. No, where I show it here. Basically, we learn new metrics, but we also will learn 2 things about how to at least try to predict the performance in the future. Do you think that other kinds of assets, such as cryptocurrencies, could work better in this kind of experiment? I don't know. My not just opinion, the evidence I see that when we use only some, basically, I think in 2020 to rely on the market data from Yahoo Finance and extracting some fancy formulas from it is not working. Because this is simply like what everyone already did years ago and dozens of years ago. I think what is really working today is combining market data with fundamental data with alternative data. And usually this data is obviously not for free, or you need to scrap it from somewhere, or you need to buy it, for example, in Bloomberg. So, but maybe in cryptocurrencies it could work, but I don't think so. At least I think I was running this kind of experiments for crypto and it didn't work. Because, look guys, literally what we are doing here, we are taking, okay, yes, we take the prices, yes, and we take, let's say, random data, the prices times series, and we do a lot of mathematical tricks over it. We do this fractional differentiation, we extract some statistical formulas, some technical indicators, and other formulas, but okay, we try to reduce noise in this data, but everyone on the market already exploits this data. So if we really want to beat the market, we need to find something that's much better. Does data is adjusted on the splits? Can you please specify what do you mean adjusted on the splits? Basically, for example, this data is like 3 years, 3 years, 3 years, 3 years, 3 years, 3 years, and then for the strategy, I take obviously the whole time series to calculate the strategy information, and for Matthews correlation coefficient, I take like averages. So. What do you mean by adjusted on the splits? I didn't understand the question. Yes, the splits on the values of the stocks. Splits. I mean, I'm sorry. Maybe I'm not sure. Like splits, like Tesla a few days ago. No, I think it's not adjusted for this. Basically, the data here is. I think it's not adjusted. Basically, you see, I just take Deutsche Bank from 1st January of 2000 to the August of this year, and I can just take like this yearly splits, and I don't adjust for anything. I think I'm just kind of simulating how I would behave. For example, I think with the Tesla, I would do the same. I'm taking the automotive sector. I take, for example, previous year of Tesla performance or previous 5 years, train a model on this, and try to use this model over the next year, for example, or something like this. Again, this is one possible way to do it. I'm not saying it's the only correct way or something like this. But this is like the typical scenario for example, algorithmic trading. That you just deploy and that's it. Splits. Okay. Splits of the stocks like Tesla. Sorry, now I understand what you mean. Sorry. Splitting the stock price, of course. Sorry, now I understand what you mean. Yes, then Federico answered, Yahoo data is adjusted for this. Yes, sorry, I just didn't understand what splits do you mean. I saw splitting the data. Okay, yeah, then, yeah, Federico already answered this question. Yeah, there is like adjusted close column. It's here. You can see. Basically, yeah, it has some difference, but for our purposes, basically, for trading from one day to another day, it is basically we still can catch the patterns. But yeah, it's better to use adjusted close. Any more comments, questions, complaints? All right, if no questions, I think, do you guys need a break? No, for water, coffee, bathroom? Because, no, we can stop, because what we have here, I think we still need couple of hours more, up to a couple of hours, maybe 1.5, something like this. Because next two sections will be, I think, a bit shorter. Thank you, Federico. I hope it's useful. So if you guys need a break, just let me know. I also go and make a coffee. Or if not, we can just keep going if you want to finish earlier. Yeah, I think Yuri, you want to finish earlier to go to sleep. I understand, yeah. So if no one else... +1 for the break. Okay, let's vote, because Yuri is in the night there. Claudio, +1 for the break. I don't mind to have a break either, but let's wait maybe for a couple of more answers. Okay, I think, yeah, let's make maybe like 5 minutes break, because also it's a lot of information, so let's go through it a bit. Yuri, please don't fall asleep in this 5 minutes. Okay, couple of minutes and let's keep going. Alright guys, who's already here, please let me know so we can keep going. Because I see 14 people online, but who is commenting? Only Yuri, Claudio, Federico, and Francesco, and also a guy who is Krillon2. He was also commenting, and Bruno once. And that's it. Oh, Stefano, hello. Keep going, please. Okay, that's what I can do. All right. Basically, since we discussed a bit before that this is just one realization of stochastic process, we want to have a way to have from this one single time series, I mean for doing our backtest, many time series. And as a metaphor, I see this like Harry Potter picture. Remember, there was a chamber with self-replicating objects. So basically, it's like when you touch one, it duplicates, and touching another duplicates, and this way you have many objects, different realizations. And for us, we need kind of the same framework, and we have one object, one time series that we observe, and from it we can in some way duplicate it and make many objects. And one of the ways to do it, we discussed before, there is like stochastic processes, and they will go to stochastic processes. But just imagine that we don't know nothing about geometric Brownian motion, we don't know very well statistics. We just know that we have some single stochastic process. We know that it could happen in any way, but the properties would be more or less the same, right? So for example, if this time series of this Apple stock is kind of trendy up, we know that it's kind of can be and should be heading up. If time series is volatile, we can expect that it should be volatile in the future as well. If there are some jumps, we expect some jumps as well. So there are several ways to do it. And one way how to create this new time series is to reshuffle it. It's kind of stupid, but we have our 20 years of Apple price, we divide it into 10 pieces, and we reshuffle these 10 pieces. And what we obtain this way? If the time series is very volatile and it's kind of super random, after reshuffling, it still is random and the same volatile. If it was always trendy up, if you reshuffle it, it's still going to be trendy up. And that's the interesting, tricky part, because this way we can create a combination of time series from existing time series with storing the same statistical properties, because trend going to stay the same, volatility going to stay the same. But if we reshuffle it and we still do, for example, first 10 years to train and last 10 years to trade, every time in train and test set, there will be very different kinds of time series. And if we do this combination of reshuffles and do train test, train test, train test, instead of one single backtest, we can have the combination of the backtests. And then instead of calculating one single Sharpe ratio, one single deflated Sharpe ratio, we can have many of them. We can have a distribution of the risks. And we can say, for example, that from the reshuffles, if all the reshuffles are, let's say, all have high Sharpe ratio, etc., etc., it's good for us. Second approach is about stochastic simulations. So basically what we can do, we can calculate the properties of the time series, for example, this drift up and the volatility, and generate 1000 of geometrical Brownian motions, right? When here many pass and with the same properties. So this way we can also model, run this 1000 backtests and build a distribution of the metrics. Another way that we are not going to discuss today, but it's getting more and more and more popular, is we can use historical data, train generative machine learning model, and sample from this model, which is some sort of kind of like fitting stochastic models. But with stochastic models, we will see the problem is to define the right parameters. What is the right trend? What is the right volatility? What is the probability of jump, as we discussed? What is the expected size of the jump? And GANs, supposedly, they kind of leave us without this headache. We just fit it and that's it. But let's start with the reshuffling. So basically, as we said, we can create a combination of train and test sets and compute backtests on different versions of the latter ones. For example, we have 6 groups of data. And out of the 6 groups, we want to use 2 of them always on the backtest, right? And on the picture below, you can see actually the combination of 15 testing paths that we can get from this. For example, this is number 1. We use first 2, basically, yeah, these are for the test, here 2 for the test, 2 for the test, 2 for the test, 2 for the test. You see, every time, basically, we create all possible combinations of combination of the splits of the time series. And we have 15 testing paths and of course 15 training paths. So all what we do, we take training set, feed the model, we take this testing set of 2 groups and evaluate on this testing set a backtest and save this backtest and the corresponding metrics. We do it 15 times. So we have 15 backtests, 15 set of metrics, and for the metrics metric of the interest, we build a distribution of 15 observations, and we kind of check the average, we check the tails, and this way we can actually estimate the risk of some sort of simulated options. And what's good about it? It's really easy to use. You just kind of use Python combinations. You don't need to simulate anything. And actually, when you kind of can backtrack what piece of data you're taking, for example, this piece is with the COVID, and you can use it sometimes in the train, sometimes in the test. This piece is with 2008 market crash. You can use it in test and train. So, you know, it's like allows some also historical explanation as well. Another problem that it's of course limited set of data, so basically you always can have some limited amount of these backtests, and the more you want to generate the backtest path, the kind of more you need to split the data, and for example the more you split, the smaller can be your training set, so the greater chance to overfit. So basically this combinatorial cross-validation can be a good start, and let's try and see how it's going to work. So basically, let's reshuffle our data and let's see what's going to happen, basically. That's the idea. Let's take everything the same. The only thing, all the same, the same, the same. Let's take Deutsche Bank here. All the same. I'll just show you basically what this combinatorial cross-validation in fact does. Let it load the data and everything. I'll just run, because it will take some time to run this code, so I'll run it right now. But meanwhile we can... Okay, let's wait a bit. It's still extracting the features. You see, basically, if you repeat the picture from the slides, like to obtain this 15 testing path, that's, for example, this is the combinations out of from 0 to 5. Basically, this is, for example, will be our training group, and the others ones, for example, 4 on 5, will be in the test. Here, 3 and 5 will be in the test. Here, 3 and 4 will be in the test, etc. We have our 15 groups, and we have 15 backtests. And if we visualize them, they're gonna look sort of like this, where the blue line is the obviously training set, and the orange line is the testing set. And what's cool here? This is the original one, and if we use only original backtest, we would test our strategy only on the falling market here. But with reshuffling the data, we can take into account many different situations, many different scenarios. And also we can test different, for example, falling market, which was growing and then dropped down immediately. Or for example, some sort of almost mean reverting market, or even growing market. So you see from one backtest on one realization of the stochastic processes, we do the reshuffle and we have already many stochastic processes. And they all have the same property as the original. They all have the same, basically it's samples from the same distribution. And if we sample from the same distribution, just combinatorially, we have the same properties, supposedly, at least, if our distribution is big enough. So basically saving the properties, but different scenarios, we can run now 15 backtests. And basically that's what I do in the code. So basically, as you can see, I iterate over the splits. I take, what do I take? I think I even don't do feature importance here, right? Let me check. Yeah, I don't know why, but I don't do feature importance, but it doesn't matter. Basically, I take my train and test sets based on these splits, and then do everything the same. I create X train, Y train, etc. I calculate the same metrics and predictions back and save it. Just in the previous notebook, what I was actually saving, I was saving iterative kind of like things that are moving consequently in time. So basically, I had to treat them as they're going one by one. Basically, I couldn't really average them because it was more about like, it had to have historical interpretation. No. Now, the things, they don't have historical interpretation. Now, it's just reshuffling. So basically, now I have all right just to average the stuff and build the distribution, because basically, that's what I'm going to do. And yeah, it takes some time to wait, so that's why. Maybe I have some questions about it. Discontinuities, yeah, on the pictures, of course, it looks like discontinuous, yeah, but don't forget that they're actually separate pieces of data. So basically, it's not like here is some non-value or something like this. Basically, we use the green time series and we use this as a separate object to fit the model. Then we use orange as a separate object to backtest the model. Basically, this discontinuous is not a discontinuous of data because they're separate objects. They simply separate. Don't forget that we do fractional differentiation separately, etc., etc. So basically, it's not a discontinuity in data. They're two separate objects just drawn next to each other. So it's a bit different. At 4,000 there are discontinuities. No, look, 4,000 there are discontinuities. Let me check. It was the price drop. As far as I okay, I don't want to stop the notebook, but we can check later the price drop, because it's the situation of 2008 market crash, where the banks actually crashed. So it's not it's simply a price crash of 2008. Let's rerun this code and we can check it. Basically, I think what I can show you is it was clear in the medium block. Because here we have the data with historical representation. Meanwhile, this is like do a backtest on the Monte Carlo simulation. Yeah, it's like a Monte Carlo simulation, which we're gonna do today. This we start doing today, but without actually. But instead of simulating the stochastic data, you just reshuffle it. You know, it's like a trick. It's like yeah. You see, this is basically the market crash, which was with Bank of America, which was with VFC, Citibank, HSBC. Always in the same time they have this crash. You see, it's they all have crash in this time. So yeah, this looks like a backtest on the Monte Carlo simulation. And why we do Monte Carlo simulation? Because we want to have the probabilistic interpretation. And here we assume that we don't know how to simulate the stochastic data, but we know that our data sample itself is stochastic. So if we reshuffle the samples, we can still have the same distributional properties, but different scenarios. And we reshuffle not like completely randomly each price each day, but we reshuffle the groups. So at least we kind of store these temporal patterns. We are not reshuffling the whole data just like randomly. We split into 6 groups and we reshuffle the groups. So it's also important. It's not like we did it completely random. Reshuffling the groups is like reshuffling the scenarios. Because, for example, this 2008 market crash, it could happen in the past, but it could happen in the future. It's just a scenario. You want to backtest how our model will behave in this scenario. And one way to do it is to simulate it somehow, and we're going to do it. Second way is to kind of try to put it forward and use everything else in the past. And this is the only thing that does this routine. Well, it's kind of slow, but okay. Okay, meanwhile it's running. If no questions, maybe let's go a bit further with the slides and then we will check the results. Or we want to discuss it. Okay, if no answer, let's assume we already run it. And after we build this distribution of the backtests, actually we can do a couple of really super simple things. And I'm almost sure that you guys already did the things, or at least saw the things in other fields. Basically, what we can do. One of the things we can do, we can build a distribution of some sort of... Okay, let me tell you first the procedure, and then you understand what it does. Basically, we do this combinatorial reshuffling, right? And we can do it in a bit another way, because we did like, now we do 4 groups into train, 2 groups into test. We can equalize it, and we can make 3 and 3, right? And we can calculate the metrics like Sharpe ratio and everything else, both out of sample and in sample. And you're asking, how do I predict, and how at least I measure the predictability? So basically, how can I ensure that my training in sample is at least telling me something about my performance in the future? Okay, that's how to do it. We calculate separately, for example, Sharpe ratios from in sample and out of sample. Then you do some normalization procedure relative to the in-sample performance. So basically, we will see that in the code it looks much easier than the words, and here in the words it looks easier than in the Prado's book. In the Prado's book it looks easier than the original paper. So I think the code is the easiest way to explain it. Basically, we take like maximum value from out of sample, and we normalize, maximum value from in sample, because in sample it was we can observe, right? We take the maximum possible Sharpe ratio from the in sample, and we normalize our out of sample values on all this backtests with respect to this in sample value, and then we rearrange it to be in range 0 and 1. Then we apply a procedure to build some sort of basically logits, and we build a distribution of these logits. And if the distribution is around 0, it means that our in sample and out of sample correspondence is like completely perfect. Basically, if difference between best in sample performance and average out of sample performance is 0, it means what it means, that we always behave out of sample the same as in sample, right? So basically that's what we want to achieve. And on all our backtests, we build this kind of distribution of these logits, and then we measure the left tail. And basically, if it's normalized, the left tail, we take it as a separate distribution, we make it to be summed to 1, and basically the statistics of this left tail distribution will tell us the probability of overfit, because this left tail is basically cases where our out of sample performance were worse than in sample performance. And this is basically one way to do it. And even more simple way to do it, guys, is just to build a regression. Basically, we make a linear regression, then we take in-sample regression as the input, and want to predict out-of-sample Sharpe values or any other performance that you want to predict, and you just observe the coefficient of the linear regression. And from this, you also can estimate the probability of overfitting. So basically, these are really very simple tricks, linear regression and just some comparison and renormalization. They're super simple, but actually when you're asking, how can I try to predict, how can I try to estimate how my model will perform in the future based on what I observe in sample, this is the pretty simple tools. And part of the code already has run. And let's go back now to this combinatorial splits. Basically, you see, we calculated everything. I combine them into DF results. And first, since we want to measure the model performance, I build a distribution of MCCs. And what we can see, that mean MCC is higher than 0, but there is a pretty big fat tail of negative results. But this MCC Sharpe ratio divided by standard deviation is better than 0. So at least on Deutsche Bank, it tells us that it's alright. And this is the histogram of results of the strategy. Again, on all the backtests. So we can see that on Deutsche Bank, the model will perform well. And the strategy, for the strategy, as you can see that mean returns are positive. Strategy Sharpe is also going to be positive. Probabilistic Sharpe ratio will be, as you can see, it will be not always 1. Because remember, out of 15 cases, it will be 3 times 0. And when we, you remember when we evaluated on the Deutsche Bank just single backtest path, it was 7. Probabilistic Sharpe ratio is always 1, because it was a single path. But when you calculate the histogram on these combinations, you already can see that it's not always 1. And 3 out of 15, it's 20%. It's actually 20% risk. Guys, deflated Sharpe ratio, it's even more important. So you can see in most of the cases, just to remind, deflated Sharpe ratio, this is the repeated experiments of our bagging. We run our bagging and get all the time new results. Deflated Sharpe ratio is telling us that in most of cases, our bagging will overfit. Okay, information ratio is mostly positive. Maximum best benchmark strategy drawdown, and this is already MMC. So you can see that we already could actually adapt our strategy on Deutsche Bank if we did not a single path backtest. If we did this combinatorial backtest, we already could adapt the strategy because we could see probabilistic Sharpe ratio which has 20% risk, and deflated Sharpe ratio which is mostly around 0, which is actually a pretty good insight. Here I started to run this experiment to visualize the things, but it's gonna run for a while. You see, just 6 splits out of 20. So meanwhile, maybe let's discuss these findings. So what do you see? Basically, what we show, what we saw in the previous part, that to understand this, that this Deutsche Bank backtest was actually just a lucky one out of other banks, we had to actually compare with all other banks and to see that it's actually lucky. But if we were running combinatorial reshuffling and build distribution of the backtest on just a single Deutsche Bank, we already could see that this finding is far from perfect. And you already could judge it pretty well without even running on other banks. So what do you guys think about it? Or no questions, seems like. Or just delay is too long. Ah, I see. How can you conclude the bagging is overfitted? Because when I do bagging, it means, for example, that every time I train this model, the results are a bit random, right? Because bagging is sampling from the training set. So basically, I consider that, for example, what I do, I am trying to rerun this backend training and testing until I get good result, right? Because I want to get lucky and get some nice subset of training data which will make me lucky, right? And deflated Sharpe ratio is a formula that is actually making us correction for this particular problem, for this multiple experiments, deflated Sharpe ratio. So basically, when I see that deflated Sharpe ratio on this combinatorial splits is almost always 0 in 80% of the cases, I can already assume that most of the cases my bagging is simply overfitting, because I just get lucky, because that's it. Okay, I see on the video the delay is pretty big, so I think I have to wait a bit. Okay, if no questions, guys, sorry, seems like this thing is running kind of long. I think we just better proceed with some slides and then wait. Basically, just to remind you, what I'm trying to run here is to calculate the probability strategy over fit based on this relatively simple techniques with calculation of the logits of differences between in-sample and out-of-sample, and building the regression between in-sample and out-of-sample performance. That's the code that is running right now. And the last thing I want to show today is basically simulating data with stochastic differential equations. This is kind of tricky part, because here there is no good recipe how to do it, especially when we have just one, like some price time series from the past. Some dozens of years ago, geometrical Brownian motion, which is the equation on the left, was considered as the main model for the simulating and modeling financial time series. It has 2 degrees of freedom, which is, you can say, mu, and sigma, which is drift, mu, and it's telling the price is going up or down, and sigma is the volatility. This is stochastic differential equation. Then, when people realized that actually prices can have some jumps that go up or down, there was created Merton jump diffusion model that, as you can see, with some probability and with some frequency, can have a jump of some size. And this already has 5 degrees of freedom. Also there, for example, stochastic volatility model, because all these 2 models, they assume that volatility stays the same over time, which is not true. Sigma is changing over time. That's why we replace sigma with, we build a separate equation for sigma, where sigma, basically volatility is mean reverting. So we consider that volatility is going like this. And also, for example, if we model volatility itself, or for example some interest rate prices, interest rates, they behave like this, they're mean reverting. So basically on the right you can see mean reverting model. And all these models have different degrees of freedom, and of course you don't really know what kind of process is which asset is following in which moment of time. Normally you assume that stock price, yeah, maybe it follows something like Heston stochastic volatility model, maybe, but actually there's also old model, and it doesn't have, it's kind of old. Yeah, you can assume that interest rates and the volatility is kind of mean reverting, but again, it's just an assumption. And also, for example, when you want to model some price, as you know, you want to rely not just on volatility on the drift or some probability of jump. There are other external variables. And basically, finding the right stochastic differential equation is already a huge problem. The bigger problem is to find, since you want to simulate, for example, backtest paths that are corresponding to current market situation. For example, you have a backtest of Apple 20 years, and for example, Apple was going up. It will make not much sense to generate a lot of time series that go down, because this is something what's unlikely going to happen, right? Because if you have the backtest of 20 Apple years of Apple growth, you still want to model the growth, but you want to model kind of different growth. You want to model growth that is more volatile. You want to model growth with the jumps up or down. You want to model growth where volatility is changing over time. Yes, you might want to model some scenarios when the price jumps go down, but still you don't really believe that Apple gonna disappear in a year or so, right? So basically, maybe you can use this jump diffusion model with some probability of jump such a really drop down. For example, maybe you're expecting for some new COVID or something like this, but the trend most probably is going to go up, and the volatility is also going to correspond to current market volatility. So we have two challenges here: to choose the right stochastic model and to choose the right parameters of this model. And with this approach, you have some also pro and contras. Basically, you can generate million of the backtests of different lengths. You literally can do whatever you want. You also can control the variables to test different risky scenarios. And usually people invent these models that kind of prove the theoretical correctness of everything. So basically, for academia, it's especially a good point. There are some problems. As we said, it's not trivial to find and build such an equation. It's not trivial to find the parameters of such equation. And also, if you want to use some external data sources or features, you need to create your differential equation by yourself, which is also simply not trivial. But let's see some examples of how we could do it. I'll keep this running, and meanwhile I'll open a new notebook. All the same. Let me just load the data, etc. And I'll mention one more point, which is also... No, I think let's discuss stochastic modeling, because we're almost finished here. So let's discuss stochastic modeling, the theory part. Then we'll discuss this probability of strategy overfit. And then we'll go back to the practice of stochastic models. It will be a bit more logical. So guys, any questions about these weird formulas? No questions. Usually no questions means that everything is clear or nothing is clear. Which can be the time frame to obtain the parameters for the formulas? Depends. Usually, for example, it's kind of like the baseline way, at least as far as I know and understand it. If you want to simulate Apple behavior for this 20 years and you want to obtain something similar, you take, for example, drift for this 20 years, you take volatility for this 20 years, and if you have observed, for example, one jump in 1 year down, it means that you can consider this probability of jump and something like this size of jump, something like this. So, yeah. All right, let's go back to these two things. I'll fix it. Okay. Basically, we have had now 20 splits, each of the size of 3 groups, and we can see that in sample Sharpe ratio is super high. We are just overfitting like crazy. And out of sample Sharpe ratio is kind of different, so to say. So what we want to do? I am building, basically separating these two data sets. Then I am taking the rank, which is called n star in the book, rank of the biggest in sample strategy Sharpe, and this n star will be, will be a 1 because this is the biggest Sharpe ratio. Then I calculate the ranks on the out of sample, and I reduce the rank of the biggest in sample from these ranks, normalize it, and make all the data to be, all data samples to be positive, because after I want to use the logits, I want to calculate the logarithms, so I avoid negative numbers here. And if we calculate this distribution of the logits, it will be something like this, right? Now we want to take the left part of this logits and calculate basically the distribution of this part and to see what will be the mean value here. Basically take the negative part, and probability of overfit based on this procedure of Lopez de Prado will be 61%. Basically, again, I am repeating the procedure from the book. So basically, I am taking the rank of the biggest in sample from the biggest in sample Sharpe ratio. Then for the out of sample data, I do this rank adjusted values. Basically, from the rank of out of sample, I subtract rank of the in sample, so I get like I adjust my out of sample data for the in sample. So basically, because in sample that's what I know, out of sample that's what I don't know. So I calculate kind of like degree of surprise, so to say. I make the values positive, and then I do so. I take the logarithm of, you see, I take these values, I divide them by the inverse value, and I build a distribution. And after I want to take all the values that are less than 0, because all the values are less than 0, they represent what it represents here. It's the backtests where my out of sample Sharpe ratio was smaller than in sample Sharpe ratio. And basically, I sort of rebuild the distribution again, calculate the mean value, and basically it tells me the probability of overfit, again based on this procedure in the book. And second thing I could do, which is more simple to understand, I just build a regression between these two values. And let's see why it doesn't work. Moment. As you can see, if I build basically here the in-sample and out-of-sample Sharpe ratios, it looks like we can build the positive positive correlation line between them, but actually if we fit the linear regression model, the R squared is really low, and adjusted R squared is just 0.02, 0.03, which basically means that our finding is almost random. And by this procedure, our probability of overfit is 60%, which is also almost random. So basically, this is it. This is two things from the book which also can help you to estimate the probability of overfit based on the single time series. But when you do this combinatorial combinations, you can have distribution of your metrics, and the distribution of your metrics you can do, let's say, different tricks. First trick you can do is just simply observing the values and estimating your risk, and also you can try to build some sort of predictive models and try to predict if, based on your in-sample performance, you can actually predict your out-of-sample performance. This is what you can do. And stochastic simulations. Again, practice. Here, guys, we have one problem that we didn't discuss in the slides. We know that when we extract our features not only from the close price. It's true that we can use the stochastic processes to generate these close prices, but actually, for example, technical indicators, they use open, high, low, close price, they use volume. Lopez de Prado features use these values. So actually, even if we simulate stochastic time series, which means we will simulate close prices. But how, based on the simulated close price, we get the volume, we get the open, high, low prices. And this is a really, really, really big challenge. And what can I tell you? That there is no baseline way to do it, or no right way to do it, because there are people who simply build, for example, some linear models, and they use some sort of correlation models to predict it. I want to show you one of the methods I saw in the paper. I should add you to the, let's say, to the list. When I'll share with you the notebook and the presentation, I'll also send you this paper. One of the ways to do it, you can actually use even non-linear models to predict, for example, from the close price, you can predict high, low, and open price. And what I want to say you, here what we want to do, we actually want to overfit. I want to explain you why. We have this Apple price, right? This Apple price in this 20 years has some sort of dynamics, right? We have this dynamics, and we want to use another stochastic models to simulate similar dynamics, right? As I said, if Apple was growing for 20 years, we don't really expect some dynamics like Apple will be falling for 10 years. We don't really expect it, and we don't really want to backtest for it. The same for the dynamics between close price, if you're simulating, and high, low, open. Usually, the dynamics between them should be the same. That's why what we can do, we can simply overfit. We can build a model that takes a close price as a single input and predicts high, low, and open. And I fit a super simple one middle layer, one hidden layer neural network to take one input and predict 3 continuous outputs. And the same, and why I do this? Because, for example, when I generated my close price time series, to extract other features from this generated close time series, I need low, open, close data and volume. So what I do first, I take my simulated series, and from it I generate low, open, and high, low, open with my neural network that is already trained on the historical data. Then what I do, I have a second model that takes high, low, open, close and predicts volume. So basically I have a model that takes, again, historical data, takes now 4 inputs and predicts the volume. And basically that's what I do. And don't worry, I'll show you that it works and how it works now. What I want to say again here, this is not super conventional way. Most of people simply use something like correlation models or covariance models, something like this. I think that using a neural network model is completely fine because covariance model on the past data is a clear overfit. Neural network is nonlinear model, which is a clear overfit. So basically our goal is not to predict here something out of sample. We want to model exactly in sample dynamics because we expecting the dynamics between low, close and volume to be more or less the same. So that's the thing. Then here I took from this web page a couple of methods that generate Brownian motion, geometrical Brownian motion, jump diffusion process, and yeah. And for example, I take this close data and I calculate the mean change of the price, which is around 0 actually, and standard deviation of the price changes, which is 0.0312. And then I generate, for example, Brownian motion with mean value 0, because here we have mean value over 0, and standard deviation, which is more or less like this. And as you can see, with such a high volatility, the price actually can go down. It can go like this, it can go like this, it can go like this, it can go like this. And all the samples, they actually have the same statistical properties as in-sample performance of this time series of, I think it's Citibank, if I'm not wrong. It's not Deutsche Bank. Yeah, it's Citibank, Citigroup. And you will tell me, this is not right. And I will some sort of agree with you, because this model is like, that's how the price could go given these properties. We can try to model jump diffusion model, taking again 0 mean value, this, and we can say that, for example, this will be the frequency of the jumps. We see the jump goes down clearly, so we can take negative jump probability, and this will be the standard deviation of these jumps. And now there will be much more time series that I can show it even like this. Now almost all of our time series will be negative and going down. And how to find these parameters? Again, guys, this is the question. This is a question to us as the researchers. I am showing you the simplest possible examples how you can do it. There are calibration techniques, but let's not dive into this right now. I'm just showing you the framework, right? I'm not saying that this code or something like this will work. I'm just showing the needed steps for the framework, so you're aware of this. So okay, I generated this backtest path based on a stochastic model. I can generate thousands of them. This is the distribution of the returns. And now this is the close price, right? And look what I do now. I turn these returns into the prices here. I predict high, low, open, close. Now I create high, low, open, close. From them I predict the volume, and I create new dataset. New dataset from high, open, low, close, and volume, when only close is generated from the stochastic model, and everything else is predicted by my overfit neural network. Overfit meaning that I wanted it to be overfit, because I wanted to exactly replicate the dynamics. As you can see, if you plot, for example, high and close, and for example, open and close, basically it should be legit for our purposes. And then I generate thousands of such things and I do my backtests. Basically, now I'll show you just on one single realization of the stochastic process. Basically, I'll do just one thing. But we already saw, for example, when we do this combinatorial things, we want to draw basically the distribution of the Sharpe ratio, etc., etc., etc. Here, you generate thousands of these backtests with properties that you think are right, and do the same as on the previous notebook. Here, for simplicity, I run on this single paths. And basically, you can see it's even kind of similar. I can tell you that, for example, Citibank could go like this. You see, it still has this big jump down, right? Just like this jump down. Just in the start, it was grew up a bit more, and the end, a bit different dynamics. But still, it could go like this. And I just received it absolutely randomly. It's absolutely stochastic generated data. And we can see that on this one single realization, our strategy performed actually even better than the benchmark. Better from the probabilistic Sharpe ratio, not good from the deflated Sharpe ratio, as you can see, because the variance is very high. But if you looked at the MMCs, they were low. So basically, what we can say? We can say that at least on this realization of stochastic time series, it's not good. And if we run it 1,000 of times, if we obtain 1,000 or 10,000 of such stochastic time series with such similar properties, I can okay, I'm not assuring you, of course, but I can bet something that our average MCC on the simulations will be negative. And this is, guys, will be another proof for you that you can't just take these statistical factors and predict prices of banking companies very, very, very well. And also I can tell you that this feature importances will also change a lot over time. So basically that's it. That's about the simulations. What do you guys think about it? Let's discuss it for a while. I read about stochastic processes on some books by Paul Wilmot. I think I'm not familiar with this one. I read about stochastic processes. Basically, I had like university course, and after that, I will show you today one book because I made my master thesis was about like options priced in these neural networks. So I had to use basically some stochastic model for simulations. And I'll show you the book that I used to prepare for my thesis. So that's where I read about it. But it was a bit more applied, I would say. Of course, Yuri. I just sorry. To be honest, I didn't prepare everything like very well. Basically, I'll publish the code and the slides, just maybe not today. So I just want to work with it a bit more. But I think first days of the next week, I'll share all the code with you and everything. Because basically here is nothing, secret or something like this. I'm using libraries, okay, this is the code from this web page. This neural network, it's also nothing secret here, and the approach is in the paper, so of course I'll share it. No, I see that there is no comments on this thing, so is it too complicated, or everything is clear, or you have some doubts about it? So maybe you can at least comment, like if you have no questions, it's like you can just comment something, please. Pass the amount of ink and digest in a single session. Yeah, I agree. It was a bit too much, but basically, it's all about a single topic. It's all about overfitting. So I agree. It's like I mixed metrics. I mixed this combinatorial things, and I mixed stochastic processes. And yeah, I think it's kind of too much for a couple of hours. But it's all about overfitting. So I think at least if you digested the approaches and basically what this approaches aim for, I think it's already good enough. Good enough as a result. Basically, what I wanted to conclude this workshop with is some sort of education roadmap. About GANs, guys, GANs, I can send you the papers. Unfortunately, I didn't work with the GANs for stochastic time series generation. I worked a bit, but it was pure research. What can I tell you? The idea with GANs will be the same as with the stochastic processes. You simply generate the scenarios, just instead of differential equation, you have a neural network that generates the same things. So nothing kind of changes from the approach point of view. Yeah, and I want to finish with education because usually I receive like many questions like what need to study, where can I read about the things, etc., etc. And I think it's even if you guys already know about it, it's good to repeat. Maybe you can find something for yourself to at least to systemize the knowledge. Basically, I think based on your questions, you guys asking like not simple questions, so I think you don't really need to repeat the basics of like what is logistic regression, what is NumPy, what is mean, what is variance. So I think if you really want to repeat the basics, I recommend Quantopian lectures. I think they're really good. And before I used to recommend the books from the Quant Start, but now I think they actually have more anti-patterns than good patterns. So I mention them because when I was just beginning, they gave me some insights. But for now, I think that I don't really recommend them. What I really recommend after you already know what is NumPy, pandas, mean and variance, There are 3 books that I think are good, for example, for some graduate level, like if you do some bachelor's or master's degree. I think these 3 books are really good. First book is basically you literally study how to apply Python, how to simulate the stochastic processes. You learn how to generate this time series. You learn some simple machine learning models, how to calculate the features, do some optimization, calibration. So it's like good cookbook on the computational methods. Second book, I think is really great also on understanding why do you even care about all these simulations, because there are derivatives, there are options, futures, swaps, and other financial instruments where you actually really have to work with simulations. And when you work just with the stock prices and you think like in the trading framework, you kind of like don't really have the intuition about stochastic process, because you kind of don't care about it. You just have the stock price and want to predict it. But when you want to work on the options market and you care about not only prediction about the option price, but you talk about the option value and how to estimate the value today, it's a bit different thinking framework. So that's why if you want to go serious about finance, I really recommend to learn about the instruments. And the first book is kind of, I think it's a good hands-on introduction, because it's like everything in Python. And second book, it's good for understanding mathematics. This is something what, for example, I think every guy who's in university can learn. It's like university stuff. These 2 courses, I think, are a bit more complicated, but I think they're really must-on. First one is specialization investment management with Python machine learning. This is really good for learning about asset management, and for learning for asset management, not from the point of view, it's like I got 10 options where can I put my money, let me minimize my risk-adjusted returns with Markowitz. No, it's much more smart. They actually talk about alternative data. They talk about basically when you manage your portfolio, you don't just care about I want to maximize my Sharpe ratio, because for example in the pension funds there are also liabilities, and for example if you're planning for your pension, you're planning not just I want to have as much more money as possible. You need to pay for your kids' education, you want to buy houses, you plan for some fixed expenses every year. So this course is teaching, it's a bit complex because it's talking about much more practical things. And the course on the right, the specialization, it's complex from the mathematics point of view, because they talk about reinforcement learning, and this guy, the teacher Igor Halperin, he's like building connections between quantum physics and reinforcement learning, so it's not always trivial, but it's extremely insightful. So I recommend to study these courses, and in the end, these 3 books, I have them all in paper, and I find them all super valuable. Basically, first 2, Marcos Lopez de Prado, they are model agnostics, and they teach you this framework. Basically, today what I showed you, I didn't show you like super cool algorithms like reinforcement learning, GANs, deep learning. I showed you the framework. And Marcos Lopez de Prado, his books are about the framework, and I think it's super insightful. And this book is this book I think is more detailed way of this course on the right. It's also Halperin is one of the authors, and this is about algorithms. So basically, if you really want to learn a bit more about deep learning, GANs, reinforcement learning, recurrent neural networks in financial framework, and correct, not like I just reapplied the code from the NLP to the finance. No, they do everything in the correct way. Basically, they show, for example, how ARIMA grows into a recurrent neural network, which is super cool. Then this book on the right is right way to go. So Lopez de Prado is a bit more about frameworks and approaches that are model agnostic, and the book of Dixon, Halperin, and Bilacon is about basically it's about the algorithms. And I also recommend you to play with the Numerai tournament. It is also some sort of like both. You need to know how to work with the models, but also it's more about approaches, because for example they give you encrypted data, so you don't know what any feature means, so you have some factors that are obfuscated. You have target, which is obfuscated, you just know that it's financial data, you need to predict it. So it's a really good exercise to play with. And of course I have to promote my my blog and everything, so if you want to connect with me, I'm open to work on different projects with you. So if you want to ask me any questions or need any support in the projects, I'm open to connect and collaborate. Basically, in a nutshell, that's what I wanted to show today, and now I'm all yours to answer questions, discuss some cases, projects, listen to the complaints, discuss live, whatever you guys want.